They're saying that their lower pricing is attracting customers. Also, we're seeing customers spending a little bit more as inflation has dropped back. So we could see that stock pop at the start of trade. They've upgraded their guidance around profitability. British Land in focus, buying 7 retail parks. They say they're 99% occupied, these retail parks, to give a sense of the quality there. No change in guidance from that business. And BAT, a double downgrade there at Morgan Stanley. They prefer Imperial, as Joe was telling us. What Nestle as well, a downgrade there from Citi on perceived pricing constraints, Guy.
Let's talk about the equity market open. Here we go. It is time for the opening trade. The expectation is we're not going to see very much. We're into the payroll run, maybe a bit of FTSE outperformance on the pound, plus also the oil trade, as Anna was mentioning. So here we go. We seem to be missing a few of our markets this morning, but let's see how the FTSE 100 opens. I don't see the FTSE 100 on that board. We've got the wrong board. Let's just say we've got the wrong board. Maybe we'll get some details below the surface. You've got the stock 600, which gives us the indicator that Kriti was talking about. We're down by 0.2%. What's going on below the surface?
Well, right off the bat, it kind of feels like a tale of two major stocks. Your biggest weight right now that you are seeing on the stock 600 is going to be ASML, but right alongside LVMH as well. So you are going to start seeing some of those heavyweights, your sensational 6, your core 6, really weighing on the index. But you can see those broad declines from a sector basis as well. The outperformance, though, is coming in biotech. You're also seeing a little bit of the commodity trade in there, as expected, Anna, that we saw from that oil outperformance that we were sort of expecting. We're still waiting for some of the volume to shake out, though, when it comes to the FTSE 100. I wonder how much of that is really a response to that volatility we're seeing in the rates picture.
Absolutely. So we're looking for gilt markets as well and seeing what happens there. And looking at the individual stock movers, we do have Tesco open, it seems, and we've got British Land open. Things a little sluggish, actually, to get started this morning, so I'm not going to rely too much on what I'm seeing in front of me at this point. But yeah, the broad story is the FTSE is, as you said, Kriti, moving a little higher this morning, up by 0.3%. The CAC 40 is down by 0.4%. And that's what we have across these markets.
When we look at this, what we're seeing in terms of the diversification that we're seeing in terms of the trade on the continent as well, it's worth mentioning that the underperformer this morning is coming out of France. And I wonder how much of that is in the luxury space. The LVMH read-through that we are seeing down about 0.4% in the French index as well. But again, it's coming to LVMH, to Kering, a lot of those luxury names. I'm curious how much of that is a response to perhaps the comments from Macron, the comments around the tax story. Guy, those are going to be top of mind for us.
Absolutely. Let's turn back to what is happening with the gilt story. So elsewhere, we are seeing yields moving higher. That's the trend that we're seeing this morning. So Germany, Italy, France, etc. Gilts are absolutely flat this morning, which is the Bailey effect. So gilts aren't doing anything, but everything else is moving higher. So Bailey is signaling maybe yields, the yields go a little lower, a little faster than anticipated, a bit more aggressively. So that's what seems to be priced in at the moment. So there's a little bit of green in terms of a bid that is around the gilt market this morning, where elsewhere you're seeing the bond market on the continent on offer.
And likely something that we're still waiting for it to shake out in the equity market just a little bit, but we already saw that kind of split in the currencies point. Let's see how it all folds in together and bring another voice in. We're joining us around the table this morning, Ian Cunningham, head of multi-asset growth over at 91. We thank you so much. Welcome to the program. Good morning. There's a lot going on here in terms of this morning's trade, especially around the FTSE 100, but let's zoom out here. Walk us through, in your view, the relationship between this volatility, at least that we're seeing this morning, or lack thereof in the bond market, and how that shows up in the equity market. Is that correlation still as strong as it was, or inverse, I should say, 2 years ago?
Sure. I mean, I think when we look at how markets have evolved, I mean, obviously when inflation's accelerating, That's particularly as the growth impulse is weakening, as we saw in 2022. That's not a great thing for diversification. So obviously, bonds and equities are highly positively correlated. I think as we move into a world as we are now, where growth is moderating, inflation has come off obviously very sharply, and we see quite notable disinflationary pressures as we move forward, bonds are likely to act as diversifiers. So within a broader portfolio, you're going to have bonds and equities behaving differently or actually being negatively correlated, particularly if we see growth move more quickly to the downside.
Do you buy bonds in this environment, or is that a trade that's largely been priced in?
So I think there's certain markets where there's still opportunities left. So we would say the Fed is pretty well priced by markets now. We sort of viewed August as a growth scare, and we sit mainly in the soft landing camp in the US. I think when it comes to Europe, we think policy in Europe's not fully priced yet. I think policy is very tight. Growth is quite a bit below trend, and inflation is going to continue to move south, in our view. And as a result, we will see the ECB and Bank of England do more than the market's currently pricing.
And so take us on to places that you might buy. I mean, talking about talking about European underperformance and what that does to the bond market, the economics underperforming. I mean, does the bond market across Europe look attractive? The French bond market, given the political risks, is that on the radar? I mean, where in Europe are you looking?
Yeah, I mean, to get into specifics, we like gilts. In Europe, we like Denmark, we like Norway, we like markets that can sort of pay us back in terms of actually being quite fiscally responsible. And I think the biggest position we have on in fixed income is in a US curve. So we have sizable positions in US steepness.
So you like fiscal responsibility. We're looking ahead to the budget here in the UK. What will you be watching for then, Ian? Because there's a lot of talk about growth, and there's talk about maybe whether the debt rules might be changed to enable more investment in infrastructure. How does your view fit with that conversation?
So I think it's there's the UK and then there's Europe. I mean, obviously growth in Europe is very weak, and obviously France is moving in towards more fiscal consolidation. That's going to place further downward pressure on growth and inflation. I think in the UK there's a bit of a balancing act going on. Obviously, it's kind of a bit of robbing Peter to pay Paul in certain instances, and we think that there's a few risks around some jiggering of the fiscal rules within the UK, and I think we've seen that in the bond market in the last couple of days in terms of some of those concerns.
Do you think that's filtering through? Is that something that is spooking gilt investors, or is it something that they say, well, we need investment, so if it's for that, if it's not for day-to-day spending, then we look through this?
Yeah, I think it obviously depends where that investment is, what it's categorized as, and I think the market will be a little bit nervous about that until it sees the facts on the table.
Should I be buying China? And if I'm buying China, what am I selling?
It's a good question. I think when we look at China, we've used the last couple of years to pick up exceptionally good companies at very discounted prices. I think when you look at how things have evolved now, obviously there's been a massive repricing. Yep. Some of those areas we would say that we've been buying in the last sort of 18 months have now moved to valuations where we want to take a bit of that off. But there are still a lot of positions we own that are very cheap relative to their respective fundamentals.
So you see more gains still to come. If you haven't had the foresight to invest over the last couple of years and you're wanting to put money in now, am I selling the US market to buy this? Is this a zero-sum game?
So I think the path of things, particularly within the emerging market space, is the market investors in general are very long of areas like India. Yep. And have been very underweight areas like China. And obviously when we get these big positioning squeezes, we're obviously seeing how dynamic they can be. I guess the big question mark for us and for investors more broadly is Chinese authorities, this is the most serious they've been at trying to turn things around, and they are notably trying to end the deflation in property prices, which is a bit of a debt deflation spiral at the moment. The jury's out as to whether they're going to do enough to achieve that. But I think from an asset market perspective, we're open-minded as to how far this rally can go, because there is price-insensitive buyers, there is swap lines being provided by the central bank, and we've seen instances in the past. The HKMA did it in 1998, and the market went a long way over a period of 18 months. And so we're weighing those things up at the moment.
So on that point, so if it's China's gain, is it money comes from America and detracts from that story that we've known and loved in 2024? Or is it India's loss and other emerging markets' loss if money goes into China, do you think?
I think that the likelihood is is there's probably not a lot of money going to come from US investors rushing back into China, given all of the geostrategic challenges. I think when you look at areas in Asia, obviously the weakness in China, Japan's been a key beneficiary of that, India's been a key beneficiary of that, and so there is a reasonable chance you see some of that reversing.
How does the currency story, especially going into the U.S. election, affect how you position going into 2025?
So I think the U.S. election is obviously presents tail risks associated with it, and I think our basis of approaching these sorts of things is we can't sort of bet a central roadmap on the explicit outcome, because it's a bit of a coin flip at the moment. But we will draw up plans as to how we will address things as certain scenarios play out.
Where does that show up? What kind of plans are you drawing up for each candidate?
So we would say if we have a Harris administration, I think in all likelihood it's going to be more of the status quo. There is some risks around corporate taxation and the like that we may see come through. If we have a Trump administration, then it's a question of how much is sort of bluster that's coming through versus what will actually be implemented. If the Trump administration is serious about implementing material tariffs, which they appear willing to do based upon the fact that they believe it didn't have much of an effect on the US last time, we would say that presents quite a sizable tail risk. And we would respond accordingly. And we already have positions in portfolios that we believe will benefit in those scenarios.
Okay, what are those positions? What do they look like? So how do you hedge the inflation tail risk? How fat is that inflation tail risk right now? Not just in the US, but broadly as well.
So we would say, for us, gold remains a key asset. Gold has been a beneficiary in recent years of central bank diversification, on the basis that the US weaponized the dollar. And so a lot of central banks don't want to hold the dollar. We think it's obviously been a big headwind to gold has been the fact interest rates have been very high, so the opportunity cost of holding it has been elevated. As we get global easing, that provides another tailwind, and then obviously any fiscal risks and the like would amplify movements in gold.
But that's not an inflation. You're saying that that's a disinflation tailwind for gold. How do I hedge an inflation headwind, sort of an inflation risk story if Trump takes the tariff story on, China stimulating, etc.?
Yeah, we would say in that environment, gold is probably going to do pretty well on geopolitical risk.
So gold does great either way, basically.
Not either way. If we see a world where basically central banks have to reverse course and start jacking up rates, then you're not going to want to be hugely long gold.
Right.
We would say the position that we have on, which is US curve steepness. We believe the Fed is serious about protecting the labor market, and ultimately, if we see any kind of concerns around fiscal risk in the US or any kind of longer-term concerns around inflation, and we do think equilibrium rates are higher in the US, so we would expect the 30-year yield to gravitate somewhat higher than it is now, while the front end remains lower and comes maybe a bit further down.
Ian, we've been around the world. We've covered quite a lot. If you think about from where we are right now with your view of the world, what are you most excited about as either a trade or an investment over whatever time frame? What's the thing? Maybe it's gold. Maybe it's something else that you're most excited about at this point.
Yeah, I mean, I think there's a very long answer to that question, and then the shorter answer is basically
the short one.
I think we're ultimately medium-term investors, and we're looking for major forces and themes that are going to influence the global economy and asset markets over a kind of a 5-year horizon. And two of the big forces are a capex spend. So there's huge geostrategic driving of capital expenditure. In the US, we see that through the CHIPS Act, the Infrastructure Act, the building of all these fabrication units through the US. This requires a lot of materials, a lot of steel, a lot of infrastructure build-out. So we like consultants that are specialists in that space. We like resource companies. The other major force and trend is the AI trend, which we do see as being very disruptive on a 5-year horizon. And particularly linked into that is areas that connect with both in terms of the likes of semiconductor equipment companies.
Data centers,
And
that seems to be both of those things, doesn't it? Guy?
Nuclear power seems to be on the agenda now as well. Ian, great to see you. Thanks for stopping by.
Thank you.
Ian Cunningham, Head of Multi-Asset Growth at 91. Thank you very much indeed. Let's take a quick look at the core 6 and figure out what is happening here with the big stocks out of Europe. Downgrade on Nestle, down 0.9%. LVMH, Ferrari, ASML and Schneider are all soft. Novo Nordisk is keeping its head above the parapets this morning. Maybe an area that you can seek safety in. That stock is a little higher. Let's figure out what the single stock stories all look like, though. Joe Easton, over to you.
So we are starting to see some moves higher in Tesco's. It was a little bit unchanged at the open, but that stock gaining now in London. As we mentioned earlier, the sales are raised in terms of the guidance, but a note from Jefferies today saying that actually the buy side was probably looking for a little bit more in terms of the numbers from Tesco, so that might be constraining the stock. We also had numbers today out of the big travel caterer SSP, looking a little bit soft on some of those sales, and the one hit a little bit hard today is Bouygues Telecom over in France. Apologies if I have butchered that name, but that one is falling because they had some guidance as well. Now the top line looked really strong in terms of the 2024 numbers, but when you dug a little bit deeper into the statement, there's a line in there saying that they're now only seeing modest growth in the French telecoms market, and that is what analysts are pointing today as potential weakness. So that one declining over in Paris was actually halted earlier today. And SSC, the power company, delaying some of their renewable projects, but actually upgrading their main guidance. So that one looking pretty strong in terms of your earnings movers today. Then over in real estate, we did mention British Land raising around 300 million quid in a share sale to buy those retail parks around England, mostly in the north and the Midlands. That one is coming down. It was at a discount. Vonovia, it's got some fresh funding from private equity. That one slipping very slightly. And this one down the bottom, it is an M&A target over in Spain. Lara España, that one gaining on an increased M&A bid from the firm last night, coming in late in the trading day. And then in terms of SAP, just flashing up that one because we have had fresh reports around the US expanding a probe into some of the alleged price fixing in that space in terms of government agencies, potentially affecting around 100 government agencies. We will, of course, await a response from SAP. We have reached out to them, so we'll wait for that one. But that stock coming down 1.5% today. Then, really interesting on the ratings changes. It's like Christmas when we get all of these rating moves. So as we mentioned, BAT downgraded at Morgan Stanley, seeing that one declining 1% on the issues around illegal vaping, according to them. Then Zurich Insurance, this one downgraded over at Exane, which says the company is heavily exposed to declining US Treasury yields in terms of their investments. So that one coming down to underperform. And then finally, you mentioned Nestle. Citi has been buy on this stock since 2016, but today downgraded, saying that pricing across Nestle's products is starting to ease, and that one is slipping over in Switzerland. We're down 0.9% for Nestle this morning.
Joe, thanks very much. Joe Easton from our equities team. It's like Christmas for Joe when he gets all these ratings changes. You can tell what makes his morning. Interesting, not that much movement in Tesco. I mean, it's up 1.5%. Maybe that's all you get on a pretty small profit upgrade. But I saw some of the opening calls, some of the suggestions from the brokers before they put their numbers out were a bit more aggressive to the upside. So interesting that one hasn't gone so much higher. That's the one that caught my eye this morning.
I've got my eye on a lot of the automakers. We're counting down to that EU tariff vote on China as well. You're seeing underperformance in the DAX this morning. Volkswagen down about 1%, taking with some of the other car makers as well. We'll see how long that lasts.
Yeah, the Germans don't want the tariffs.
Yeah.
Because they're worried more about what is going to be the reciprocal comment coming out of China. The European, elsewhere, the French seem pretty comfortable with the concept. It's really whether or not you're sort of projecting that you want to defend a domestic market or an export market.
And it depends if you're only thinking about cars. You know, at the time that the tariffs first came up, a lot of people were saying, well, France, okay, yeah, they might back it on the car front, but won't they be fearful of retaliation in another sphere, for example, on the luxury side of things? But maybe that doesn't go down too well domestically in China if you try and do that.
I'm having a little bit of deja vu here. It feels like the Germans are turning around on policy quite quickly. Initially on the cross-border conversation, now on what tariffs might look like. Habak making some pretty strong comments over at the Berlin Global Dialogue, saying he doesn't want tariffs anymore. He was one of the early proponents of them.
Everybody's doing their own thing. This is not Draghi-esque, is it? We're not doing this together.
Mario would be disappointed.
Mario would be disappointed. Yeah, that certainly seems to be the tone coming through.
This is a new category of news, I think.
Yes.
Yeah.
What is disappointing and not disappointing for Mario Draghi?
Yeah, absolutely. I think we'll keep across that. We'll have a new code for it on the Bloomberg terminal before you know it. Right, we'll certainly keep across the car story. Coming up, Tesla posts its first sales increase of 2024, but the gains fail to impress investors. More on the EV maker's road ahead next. This is Bloomberg.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The U.S. market is a very important market. I mean, it's one of the largest EV markets, and also I think also a market that's ripe for technology innovation. But at the time right now, I think the policy is evolving and also making challenging for Chinese companies to enter. Being more local is not because tariff, it's not only because tariff, because as a company has aspired to be a leader in a market like Europe, we have to think about becoming more local. You know, we have to have more local team to build our local brand and also have more local presence. And also, you cannot rely on an export-only strategy to deal with a local market like such a big market like Europe.
That's how you get around tariffs. You build them locally. Xpeng Vice Chair Brian Gu speaking to Bloomberg ahead of the EU vote tomorrow on imposing EVs. Tesla, let's talk about that angle as well, posting its first increase in quarterly vehicle sales this year, but the gain has disappointed investors, expecting more of a bump from China's higher electric car subsidies. Let's figure this all out with Craig Trudell, who joins us now around the table. Let's talk Tesla first of all, then we'll come on and talk about subsidies. This is not convincing stuff from Tesla. And the whole premise seems to still be on the robotaxi narrative that ultimately is still coming. The shares have risen through August into September. The shares have done really well. But again, a dose of reality, how much of a challenge this remains for Tesla, that is still a car company at this stage. It's not a robotaxi company.
Yeah, that's right. I mean, they really ripped in the weeks leading up to this number. So, you know, the number is trending positive, both, you know, on a sequential basis and a year-over-year basis. But when you pan out and really sort of look at how this company has trended over, you know, say 2 years, you're not seeing much in the way of growth whatsoever. Yeah. You actually may see a slight decline in deliveries this year unless they really have a hero fourth quarter showing. And there are reasons to maybe discount the likelihood of that when you look at the way things have been trending in the U.S. Here in Europe, sales have been really bleak. And in the U.S. just yesterday, we saw a change on the order page for Tesla where the cheapest version of the Model 3 in the U.S. is no longer available. So you do still have some things sort of moving against you if you're Elon Musk trying to grow in this environment. And he wants everyone to kind of, pay no attention to that. I have this bright, shiny object that I've been talking about for years now that's going to save the day.
We'll get to the details of these Chinese and EU votes on the Chinese tariffs as well. Does that have any read-through into Tesla's numbers?
I think it may actually have some impact here and be sort of feeding into why things have been trending so poorly in Europe. The company has, speaking of localized production, as we were hearing from Mexpeng earlier, they do have Model Y production in Germany, but they rely on China for imports of the Model 3, and that's a very important model for them in Europe and globally. And it does appear that they will get hit by a smaller additional tariff than a lot of other companies. The EU, in the course of investigating the extent to which each company has benefited from tariffs, came up with a number that is smaller for Tesla than a lot of the others. That being said, it's still the case that there's some pressure being put on those imports coming in from China, and that isn't helping matters.
It's fascinating that he's talking about this being the Achilles heel, given that Tesla has that exposure in Berlin and in Shanghai. 3 years ago, that's what rallied the stock. It cushioned them from some of the hits the other automakers were taking.
Yeah, and now it's really interesting to watch the web of production and imports and exports of these cars and who is going to fall foul of the tariffs and who is not. And on that point about local production, we were hearing from Mexpeng and maybe Tesla motivated, perhaps depending on the size of the tariffs, to produce more in Europe. Do we get a sense of if that's enough for European governments? Do they just want cars produced in Europe, or do they want German and French-owned cars to be produced in Europe?
I mean, I think it's absolutely a case of all the worst fears of member states have been confirmed of late about, this incursion of more Chinese competition, right? We're only seeing day by day, Volkswagen coming out and talking about closing plants in Europe, Mercedes and BMW and Stellantis doing profit warnings. Is this all at the feet of this, new Chinese competition? No. But does it sort of, work together to kind of, reinforce concerns that, maybe we shouldn't be so open to this, these new entrants? I think it absolutely does. And so you are going to hear some voices, raising concerns about retaliation, I think particularly from Germany. But there is a real concern about European jobs being at risk because of the fact that we have this flood of new
because it's really interesting, if we shut a VW plant, if those people who used to work there go work in an Xpeng plant, I don't think the German government sees that as the same.
No. I don't think the Germans see that the same in their totality. You don't know what's going to happen 10 years, 20 years down the road. You want to build an industry that is going to take those jobs for the long term. Is a European car if the battery is made elsewhere? Because this is where the challenge seems to lie right now, building batteries in Europe.
I think that's a really important and valid question, and something that leaders are going to have to ask themselves in terms of, just how willing they're going to be, to allow for this. I think it's really important that gets localized, given the risks that we've seen in the past.
We'll find out tomorrow. Craig, nice to see you. Thanks very much indeed. This is Bloomberg.
Top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We are the single best place to do business in the world. We are the luckiest people in the world. Can we screw it up? Yeah, we can. The notion that we are spending $2 trillion in excess of what we take in peacetime with full employment does not bode well for the availability of capital to do what we need to do for the next generation. We're spending the next generation's money currently.
That was, well, speaking exclusively to Bloomberg, Apollo CEO Mark Rowan, who cautioned against the current pace of US government spending. That was him speaking, of course, and he was talking there about spending the future's money. Interesting thoughts. Let us turn our attention to the rates trajectory, what that does to distressed debt investing, what that does to commercial real estate investing. Victor Kosler joins us, founder and CIO of opportunistic credit firm Strategic Value Partners. And it's really nice to see you once again here in London. Thank you for coming to talk to us, Victor. Let's start with the big picture around rates then. There's, we've seen rate cuts, a big rate cut, 50 basis points. Does that mean less opportunity, fewer opportunities for a business like yours if rates are coming down and companies are less distressed?
So Anna, if I could just even set it up a little bit, right? The Fed is cutting rates, ECB is cutting rates. Positive, just where we are. The US economy is growing. Europe, struggling a little more. Germany, near recessionary kind of conditions, right? But in a world which kind of looks like this, we think it's kind of okay. There's no...
Is that the perfect recipe for a business like yours? Things are not booming. These economies are not booming, certainly not Europe. So there's just there's enough distress around.
I know. On the surface, it looks calm. That's the picture I think I'm trying to paint, and I think you generally see that same calm environment. Underneath, there's a lot more happening. So look, in the deal world, in private equity, in real estate, we have been investing in a zero-rate environment for 16 years. 16 years, 0% interest rates, trillions and trillions of dollars invested. Rates are higher. They're no longer zero. Yes, they're coming down, but they are no longer zero. At the same time, parts of the economy are more troubled. Manufacturing, the consumer, not everything is okay, right? So you look at a world like that, you look at these higher interest rates, and you look at maturities of debt. We are over, it looks okay. Underneath, it's a full-on slog, and has been for the last year, and will be for the next 2 to 4 years.
And in that slog, you see opportunity?
Yes, exactly.
More opportunity in Europe than the United States?
Today, yes. In Europe, you've got a much slower economy. Our business is almost 50-50 US, Europe. So it's not 50-50 every year.
Yep.
But over a long period of time, that's what it is. And Europe, with a slower economy, with a much bigger manufacturing, is a much bigger piece of the economy, more problems.
In the United States, triple C's are super tight.
Yeah.
The Fed's cutting rates. The credit market looks as if it's having an absolute ball right now, particularly at the triple C end of the market. What is the risk around this? This looks too good, almost too good to be true at the moment.
It is too good to be true, because even as the top part of high yield is doing well, actual defaults, if you include distressed exchanges and defaults together, distressed exchanges are when people go out, they take a discount on their debt, they extend the debt, right?
Yep.
So you've got to think of them as a default. That plus actual defaults are about 5%. 5% is what it was that's what it was in COVID.
Yep.
In 2008, the GFC, it was 12%.
Yep.
5% is big.
COVID was artificial, though, because everybody was protected.
Yeah. Sorry, what was
Everybody was protected by the government. Like, defaults didn't happen we didn't get the cathartic moment during COVID because of the way that distressed companies were protected.
Please, I'm not here trying to tell you there's a cathartic moment coming.
Right.
Right? This doesn't look quite so visually. This is a slog as we work through these maturities, as we work through these high interest rates. We are in the middle of a 3-year, 4-year slog. Our view, the economy is not going to fall apart. It isn't like, markets are going to swoon or there's going to be a crash. Don't think so. That's not our base case. But just working through high rates, maturities, literally $2 trillion of high yield coming due over the next 3 odd years, that is the opportunity.
You say that this is not a cathartic moment, but I'm curious if there's one coming, simply because of the luck factor here when it comes to liquidity. It feels like there's so much liquidity sloshing around, helping the slog. But the minute that crunches, or the minute you see a more aggressive Federal Reserve or a slowing down that is less in the markets, that luck goes away. Isn't that the cathartic moment, or the risk of one?
The Fed and the governments are really good at managing.
Are they?
Look, since 2008, which was a cathartic moment.
Yeah.
You look over the course of the next 16 years, there have been issues. We had the Greek crises here. We had the oil and gas crash. We had COVID. And look what a good job governments did and what the central banks did. So, look, I'm not trying to tell you it's always going to be like that. But for somebody like us who loves cathartic moments, okay, don't get the wrong idea. We love cathartic moments.
Don't worry, we're journalists. We get it.
We just don't think. We just don't think when we look at the economy, when we look at the tea leaves, that it could happen. There's always, you have a base case, and then you have some probabilities outside that. It could happen, but that's not what we expect.
Does working through the slog, as you put it, and the current lack of a cathartic moment, as you put it, set us up for more volatility when we do hit that debt maturity wall? And you see it in a lot of the major corporations. I'm thinking Apple, I'm thinking Microsoft, who have borrowing at near government borrowing rates. They're looking at a pretty scary wall coming up. Is that the moment that the refinancing challenges trigger something broader?
Yeah. The investment grade markets, some of the companies you mentioned, those are amazing companies. They're not overly levered. Instead of paying 1.5% or 2% they might have paid in the past, if they have to pay 4% now, doesn't really matter quite that much. The problems, Kriti, are all in the high yield universe. These are companies which are levered. These are companies, and by the way, those maturities, they've been happening for the last year.
Yeah.
Those maturities, when you look at the next 3 years, boom, boom, like 400, 500, 600 billion a year.
Yeah.
That's where the problems are. There are cathartic moments for individual companies, but not for broad markets at large. Our view.
Not in the investment grade space, 100%. I take your point. But so many of the triple Bs and even in the high yield junk space issued at some pretty low rates. I'm thinking airlines that maybe shouldn't have back in 2020, 2021. Isn't that where the maturity wall hits more aggressively?
It does, right? It absolutely does. But I would just, a cathartic moment is when markets swoon. High yield spreads gap out to 800 basis points or more. There is lots of debt you could buy at 60 cents, 70 cents. The world we are in today, our view of where we are over the next 2-3 years, it's not that world.
Should the Fed be cutting rates more aggressively from here? Should the Fed be cutting rates?
Don't
worry about that.
The Fed is, look, we are all Fed watchers.
Yep.
The Fed with a dual mandate is now that inflation's under control. It has to worry about unemployment. And to our point of view, it's doing the right thing. Whether for what we do for a living, Guy, whether the Fed cuts 25 basis points or 50 basis points, whether the Fed reduces rates if there are 3 cuts or 2 cuts over the next 3 months, for what we do, quite frankly, doesn't really matter. Right?
Okay.
It is. Look, we're in such a different world.
Yes.
You know, high yield spreads, if they go from 325 over to 375 over, doesn't really matter.
Okay, and thinking about the specific areas of investment that you might be interested in, Victor, where do you see opportunities in real estate? We've talked a lot about the troubles in real estate as rates were on the rise, and maybe we didn't see quite a global cathartic moment, but there certainly have been episodes. I know that we had news out this morning about one business loading up on some more retail space, for example. I mean, where in commercial real estate looks attractive to you at this point?
Commercial real estate is a piece of our business, right? No, not the majority of our business. And what we find is about 40%, 45% of commercial mortgage debt has been issued against offices and against multi-family properties. The logistics business, the warehouse business, a whole bunch of the other commercial real estate business are relatively healthy. But in office, particularly if you think about U.S. office, in U.S. office, you've got vacancies of close to 20%. When those offices are vacant and you ask yourself, hey, I got a new tenant coming in, you've got to pay a lot of money to fit out the building and in free rent. So when we look at a whole bunch of U.S. office real estate, there are problems galore. We must have looked at 100 deals over the course of the last 6-9 months. We've made one investment so far. It's somewhat protected. It's somewhat sheltered. So when you look at office property, it's really hard to underwrite.
Because it's not troubled enough for you? Or
No.
It's too troubled.
It's too troubled.
Yeah, okay.
Right? You've got in office in the U.S., there's almost a tsunami coming through. You don't see it in the headlines quite as much, but underneath those debt maturities we were talking about, they are causing a tsunami.
And that's not enough to provide this cathartic moment?
It's small. It is.
Okay. Thank you so much, Victor. Thank you very much for coming to speak to us. Victor Kosler, founder and CIO at Strategic Value Partners. From commercial real estate, we need to go talk retail and retailers.
Retailers. I think the Tesco call has just finished. The company out this morning has raised its profits outlook for the fiscal year a little bit. As you can see, we're finally getting a reaction coming through. Britain's largest supermarket, pulling in more shoppers. It does seem as if discounts are working. Obviously, the club card is having an effect on that. You are also seeing inflation maybe encouraging people to spend a little bit more money, or the lack of inflation maybe is putting more money back into people's pockets. You've also got the wage story, etc., etc. UK retail reporter Jennifer Creary sitting around the table with us now. The Tesco call just finished. What do we learn on that call?
Yeah, well, overall, it's a pretty good result. in terms of its outlook. They raised it from 2.8 billion in retail adjusted operating profit to 2.9 billion, so a small increase, but an increase nonetheless. And overall, Ken Murphy, the CEO, he's pretty pleased with that. If we just zoom in a little bit on the details, so like-for-like sales in the UK, that's up 4%. If we compare that with the previous interim results in the year 2023-24, that was up almost 9% in the UK. So what it tells us is that, there are a few headwinds. As you mentioned, the discounters like Aldi and Lidl, they're really eating into the market share of these big grocers. But still, Tesco is able to stay ahead of the curve.
So that's the zoom in. Let's zoom out, though. How much of that is a signal of consumer behavior here in the UK?
Yeah, so, as you said, Tesco is the largest supermarket. It's also one of the largest private sector employers, so it's pretty representative of British consumer behaviour. And what this tells us is that, British consumers are still valuing those discounts, those offers, competitive pricing. But still, something that Ken Murphy noted on the call is that there's been a particular boost in its kind of premium offerings. So when consumers do have a little bit more of that pocket change, they are looking to kind of treat themselves. But he did say that, quote unquote, they're not doing cartwheels down the hallway. So,
down the aisles.
Yeah, exactly. So, they're still looking for that discount and that offer when they can.
There's probably space, should they wish to. But maybe not the news flow to justify it. Jennifer, thank you. Thanks very much for coming in. Bloomberg's Jennifer Curry with the latest on Tesco. Coming up, boosting the government coffers, Emmanuel Macron comes up with a plan to raise 20 billion euros by tapping France's largest companies. More from our exclusive interview with the French president next. This is Bloomberg.
Also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome back to the opening trade. We are getting breaking PMI numbers coming out of Italy for their September reading. The composite PMI falling to a 49.7 reading. The forecast was 50.2. You look at what's going on underneath the surface, it looks like it's private sector activity that's really the one to blame here. We already saw some of that contraction, some of that weakness in the factories data. It doesn't look like the services data is coming to the rescue either. Compare that to Spain, Anna. You're seeing a completely different number. September's composite PMI there rising to 56.3 versus 53.5 in August.
Does this raise questions about whether it is the periphery versus the core, or if it's just Spain doing really well and everybody else having trouble?
So that's the commentary we're getting with the PMI numbers that come through from S&P Global Market. The comment from Hamburg Commercial, which they usually add to it. The summer's coming to an end. Spain is coming up with a little surprise. Great news for Spanish employees. With the progressing upturn in sales and demand, firms are accelerating their staffing levels, which further extended in September. It seems as if they are seeming to signal that this is an isolated Spain story as opposed to something that we can read across into other economies around Europe.
When we talk about that growth picture in Spain, I'm just going to nerd out for a moment here. You do start to see the outperformance becoming very much a labor story, and this is where the migration story differs between Spain and what you're seeing in the likes of Germany or the Netherlands or Italy, for example, and that the migration story is actually pushing higher, more productivity, pushing higher those wages. It may be showing up in bursts in the data, but it's a different story in Spain than it is in, say, likes of France.
This once again sets Spain apart from other major Eurozone countries.
There you go.
It is an isolated story, it seems, for Spain. You talk about the migration element to this. It does seem as if the labour market is very strong at the moment, and that is reading across into retail and the services sector more broadly. France?
We're getting France numbers as well. Their composite PMI 48.6, the prelim numbers 47.4 there. Looks like outperformance in their services PMI there as well.
It's all below 50.
It's all below 50. These aren't necessarily expansionary numbers, but perhaps the drop not as dire as we've seen other parts.
But they are contraction. The diffusion index says month on month, but the Spanish, you compare and contrast, there's almost a 10-point gap between the two. It's absolutely staggering, the difference we're seeing in these two economies.
Well, it backs the difference that we're seeing in the yield picture, right? That the Spanish debt is now trading at yields lower than that of France.
And let's take the conversation on then to what we've heard around France and the way that they're, as the economy isn't doing very well, they're having to try and balance the budget. Some of that 2/3 through spending cuts, but also tax rises.
Macron's comfortable with tax rises. That's what he told Stephanie yesterday. Stephanie Flanders at the event in Berlin. Take a listen.
Having an exceptional taxation on corporate is something which is well understood by large companies. If this is for 1 year, given the level of effort which should be made, but it should be limited, and we don't have to forget. We have not to forget the reality of our economy, the reality of our competitiveness and our position.
That must have really hurt, saying those words. I'm okay with the tax rise. He did qualify it by saying that he thinks it should be temporary. Emmanuel Macron, the French president, speaking to Bloomberg's Stephanie Flanders in Berlin yesterday. Let's go to Paris. Caroline Conan, our Paris correspondent, joins us from there. He's got huge domestic challenges that he needs to deal with right now. He is talking about Europe and the need for Europe to get its act together and the existential crisis that Europe faces. But on a domestic story, he has to almost toe the line at this point in time. He has to accept that we are going to see tax rises. How big a surprise is it that he's having to say those words?
Because usually when he's abroad, he never speaks about domestic policies. And over the past 4 weeks, since he named Michel Barnier as Prime Minister, he hasn't been involved at all in any of the conversations about the budget, in any of the points of view and the debate about whether or not to raise taxes. So he's backing his government of Michel Barnier officially, and he's also abandoning his mantra of the past 7 years of never to raise taxes. That was part of his initial campaign pledges back in 2017. But now, of course, the deficit is going to be more than 6% this year, and Michel Barnier is looking for 60 billion euros of saving. So really raising taxes is kind of the only way to go, even for Emmanuel Macron. We know this tax is going to be technically for 1 year, only 2025, and is going to bring 8 billion euros. We already heard from the Total Energy CEO who said that was unfortunate, but it's not going to have a big impact on Total because anyway, they pay most of their taxes abroad. One concern, though, that we also found out yesterday from the finance ministry, there could be some more green taxation, including on the aviation sector. The IATA Association reacted yesterday saying that would be a disaster for the French aviation industry.
Yeah, Total's CEO seemed upset about taxes in France, but also in the UK in the same 24 hours, Caroline, something of a trend. Back to the French story, and Macron also, as you point out, more likely to talk about European affairs when he travels outside France, and he did that too, channeling Mario Draghi a little.
Yeah, and that was also one of the topics he discussed with the German Chancellor Olaf Scholz just before this conversation with Stephanie Flanders. The European tariffs on Chinese EVs, we're going to get the vote tomorrow. And clearly Macron has a very diverging view with Olaf Scholz. Olaf Scholz wants to compromise, perhaps renegotiate with China, whereas Emmanuel Macron actually said that France will support these new European tariffs on Chinese EVs, because he says that this is kind of the only way, the last thing to do to protect Europe, given compared to the US and China, Europe is lagging behind. There is too much regulation, underinvestment. Macron actually said that Europe could die if we continue like this. So quite strong words there in this Berlin dialogue. Now, the problem for Emmanuel Macron is that since he's got a lot of domestic issues and he's been around for a long time, his influence in Europe has kind of diminished, and his influence is not weighing so much as it used to be on the other European leaders.
Caroline, thank you very much indeed. Caroline Conan. Talking about the oil sector, quick look at what is happening with the oil price over the last couple of days. Stephen Szczepinski, how do I not be able to say those words? Anna's going to do it from now on. Joins us now. Stephen, talk us through what we're expecting from the oil price over the next day. We're waiting to see exactly what happens on the geopolitical front. What is the market pricing in?
So the market is pricing in just a little bit of war risk. I don't think they're really pricing in a large disruption to oil supply. Now, this happens a lot, right? There's attack, a counterattack, and you see prices spike, and then they come down. The fundamentals of the market supply-demand outlook, bearish. But when this happens, you see a small increase because Iran is a major producer of oil. So if there is an Israeli strike on Iranian oil infrastructure, it could take off about 1.5 million barrels a day, which is about 1% of the global oil market. A smaller strike could be maybe 400,000 barrels a day, and that would see a larger increase in oil prices than we are right now. Think about testing the $80 level for Brent instead of about 74, 75 where we are right now. A bigger problem would be if they hit nuclear sites, and that would be a larger full-blown war in the region and spiral into a larger impact on prices.
Thank you very much indeed. Stephen, I'm not even going to try it. Stephen, thank you very much indeed. Greatly appreciated. That's what we're going to be watching for the rest of the day. The opening trade is done. We have opened the markets for you. The pulse is up next. We are going to walk you through all of the price action. That's next. Fran is up next. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Your fix Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges. Britain's next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Europe's main indices struggling for direction this morning as China's record rally loses steam in Hong Kong. In Japan, the yen weakens as the new Japanese Prime Minister casts doubt on further BOJ rate hikes this year. Traders add to bets of a November rate cut after the Bank of England Governor Andrew Bailey says he sees a chance of more aggressive easing. The pound slides to its lowest in a fortnight on those dovish comments. Meanwhile, in the US, President Biden warns Israel against attacking Iran's nuclear sites as he seeks to de-escalate tensions in the Middle East. The G7, meanwhile, considering rampant...
Hey, ChatGPT.
Hello there. How's it going?
It's going really well. Today, I'd really like your help solving a math problem.
I'm all ears. What math problem can I help you tackle today?
So I'm going to write down a linear equation on a sheet of paper, and I'll show you. And then I'd love your help working me through it. But importantly, don't tell me the solution, just help give me hints along the way.
Got it. Okay, I see it.
No, I didn't show you yet. Just give me help along the way. 1 second.
Whoops, I got too excited. I'm ready when you are.
So, ChatGPT, what equation did I write down there?
Ah, I see it now. You wrote down 3x plus 1 equals 4.
Yep, exactly. So what's the first step I should take to try to solve this?
The first step is to get all the terms with x on one side and the constants on the other side. So what do you think we should do with that plus 1?
Okay, I'm going to try to subtract 1 from both sides, and then I'll see what I get.
Great idea. Perfect. Now, what do you get when you subtract 1 from both sides?
Okay, so ChatGPT, this is what I ended up with. How does this look?
Spot on. Now you've isolated the term with x on one side, and it looks like 3x equal 3. What do you think we should do next to solve for x?
I'm not sure. Can you give me another hint?
Of course. You have 3x, and you want to find the value of x. Think about what operation would undo multiplication.
Is it subtraction?
Close, but think of the opposite of multiplication, because 3x means 3 times x.
Okay, I think it's division. Let me try to divide both sides by 3, and let me see what I get.
Bingo! Go ahead and divide both sides by 3.
Okay, so ChatGPT, this is what I ended up with. How does this look?
It looks perfect. You've solved it, and x equals 1. Nicely done. How do you feel about solving linear equations now?
Yeah, honestly, I've
I'm not pretty confident I can solve linear equations, but why would you ever need to use this in the real world? I'm really skeptical.
That's a fair question. Linear equations pop up in a lot of everyday situations, even if we don't realize it. For example, calculating expenses, planning travel, cooking, and even in business for profit and loss calculations. It's basically a way to solve problems where you need to find an unknown value. Plus,
Wow,
it's...
okay. You know, I have a lot of unknown values in my life. I'm totally convinced I'm gonna learn math now.
I love that attitude. Math can definitely help solve some of life's mysteries. Whenever you're ready to dive into more math, I'm here for you. Anything else you'd like to tackle today?
So ChatGPT, I really love that you taught the value of math to my friend Mark. And I wrote one last thing I'd love if you could take a look at.
Of course. I'd love to see what you wrote. Show it to me whenever you're ready.
Okay, so this is what I wrote down. What do you see?
I see. I love ChatGPT. That's so sweet of you.
Yeah, well, I really appreciate all the help.
They're quite restrictive across the globe, and this gives central banks an opportunity to recalibrate those stances in line with the slowing in inflation that we are getting. So the way I would characterize the global economy is that there's kind of signs of slowing. It's more a mid-cycle slowing. We're not looking for a recession here. But as I said, that slide in inflation is allowing central banks and giving them that space to lower interest rates.
On the Bank of England, then, as they make these adjustments, what do you make of these comments from Andrew Bailey? It seems to be quite a pivot from a cautious tone to a tone where he is at least opening the door to a more dovish, more assertive, more activist, as he framed it, Bank of England.
Yeah, I mean, the UK economy did post pretty impressive gains in the first half, but we have been looking for those gains to slow down into the second half. So we do have GDP growth slowing. I think, again, key is the slide in inflation. Through the first half, I think what was preventing the Bank of England from pivoting towards a more dovish stance was very elevated inflation. But now with the help of the slide in oil prices through the third quarter, also with services inflation finally showing signs that it's breaking lower, and wage inflation starting to come off. So signs of that persistence in wage and price inflation finally easing. I think the Bank of England as well has the space to ease here. There's nothing suggesting they need to move aggressively. So we have been looking for a quarterly pace of cuts. But, I think risks are shifting that quite a few central banks could be in a position to deliver monthly per meeting cuts.
You think November, I mean, certainly the markets are pricing in now a November cut from this Bank of England. Do you think that is the most likely scenario? And where does that leave you in terms of the cycle of cuts for the BOE and where rates end up next year?
Yeah. So I think November, yes, 25 basis points looks highly likely. I think thereafter we still think it's more like a quarterly pace of easing, which would still leave rates in a slightly restrictive territory, sort of middle of next year. I think relative to the Bank of England, there is more space for cuts from the ECB, from the Fed in terms of the overall cycle. But the BOE as well has an opportunity here to adjust rates lower.
We have non-farm payrolls out on Friday, of course. What kind of number would we need to see to get a jumbo cut from the Fed back on the table in terms of market pricing?
Right. So, we are looking for 125,000 non-farm payrolls. So that would be, a little bit compared to the last number. It is still a slowing in the 3-month run rate. So there's still a slowing in labor demand ongoing. I think that would still leave the door open for a 50 basis point rate cut. But I think, most likely if you saw something around 100,000, that would make a larger rate cut more likely. So at this point, I think with the combination of inflation coming off and that slowing in private payroll growth in particular, to around a 1% pace, which historically has signaled a quite abrupt slowing in the U.S. Labor market, I think that would leave the door open. I mean, certainly Chair Powell is guiding us more towards a 25 basis point pace at this point. But remember, we have 2 more payrolls until the next.
What is your assessment of where they are? They're switched the focus to the labour market, away from inflation. Certainly, that seems to be the lines we're getting from a number of FOMC officials. Where are they in striking that balance in terms of the cooling at the edges of this labour market and ensuring that it doesn't drop to levels that would be uncomfortable? He doesn't want to see any more labour market erosion. He's been clear on that, Powell.
Correct, yeah. So I think, as I said, I think that slide in inflation to around the 2% pace, which is in line with their target, is allowing the Fed to focus on the second part of its dual mandate, which is delivering full employment, right? So at this point, they have that space to ease. I think what the Fed is seeing and what we're seeing in terms of the labor market dynamic is a slowing in hiring, but we're not seeing that shift towards layoffs. We had the JOLTS data this week, the ADP payroll numbers as well, which all suggest that there's a stabilization in the labor market after that earlier scare, right, with the unemployment rate picking up. But what we think is that a lot of that rise in the unemployment rate was actually due to labor force gains, so labor supply and immigration being quite strong. There is some slowing in labor demand, but again, there's nothing here to suggest they need to move very aggressively. But I think it's about this recalibration from a very high rate level. So it does leave the door open to a 50, but again, we would need to see some further slowing to get that.
On China, we're still waiting for more details in terms of the fiscal component. We've got the details on monetary policy. It's the fiscal part, how much and how far they go. Which of China's trading partners, Europe, the US, is going to benefit, and to what extent? Does it change your outlook for growth for next year for some of these trading partners?
Yeah, so, I mean, China here has announced a pretty bold and coordinated set of stimulus measures, and clearly the markets have reacted positive to that. It hasn't really altered our own macro forecast materially. It probably removes some downside risk to the near-term growth outlook. We're still looking for China to slow to about a 4% pace next year. I think the major issue is that there's a balance sheet recession right now, including the housing market. So house prices continue to fall. A lot of household wealth is tied up in the housing market. So the share of home ownership is very high. Those consumers and households have seen a large erosion in their wealth. So I think unless we can turn that around, and I think, again, rate cuts are really not going to help that situation, unless we can get that more direct fiscal support, I think it's quite hard to see a very strong boost to overall growth. In terms of the broader growth implications, I think the spillovers are a little bit more limited because a lot of China's issues seem to be quite homegrown at the moment.
Okay.
And the main spillovers to the rest of the world have been more through the deflationary channel, so China exporting deflation to the rest of the world.
What are markets, on the question of inflation, are markets underestimating the impact of higher oil prices on that inflation picture, given the tensions in the Middle East? In some forecasts, you could be looking at $100 per barrel per barrel if things escalate even further from here.
Yeah, so through the third quarter, we had a sharp slide in energy prices due to the slide in crude oil, and we're still seeing that pass through to the inflation numbers. I think if we do get now a spike, 10-15% higher oil price, yes, that would reverse some of that easing in inflation. And it would also be negative for growth. This is a supply-driven potentially increase in oil prices that would cut global growth by a couple of percentage points. But right now, I think the ranges that we're seeing and that we think are likely, our base case is for oil to go up to $80 per barrel. That wouldn't materially move the needle either in terms of inflation or in terms of growth. But again, that benign slide in inflation and boost to growth that we saw through the third quarter could reverse a little bit into the fourth quarter.
That starts to be phased out. Currently 74.79 on Brent, up 1.2%, with you and your view at around $80 potentially in certain scenarios. Nora, thank you very much indeed with a wide-ranging take there on what is happening across this global economy and with a focus on central banks and, of course, the energy input as well. Nora Senti-Vanni, global economist at JP Morgan. Now, US prosecutors are widening a probe of potential price fixing by SAP and tech reseller Carsoft. The Justice Department has demanded that Carsoft hand over documents relating to sales of SAP products to government agencies. Carsoft says the allegations are, quote, unsupported. Coming up, we're going to have the latest from the Middle East as President Biden warns Israel against striking Iran's nuclear facilities. This is Bloomberg.
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Welcome back. The US is urging Israel not to attack Iran's nuclear facilities in retaliation for this week's missile barrage on Israeli cities. President Biden says he plans to speak with Prime Minister Benjamin Netanyahu as the US and G7 allies plan further sanctions on Iran. Israel has vowed to retaliate after Iran's missile attack, while Tehran has defended the move.
Iran's missile strike were a necessary and proportionate response to Israeli continued terrorist aggressive acts over the past 2 months. The regime is pushing the region to the edge of an all-out unprecedented catastrophe. Israel has no intention to pursue peace or a ceasefire.
We are in the middle of a tough war against evil axis of Iran, which seeks to wipe us out. This will not happen because we will stand together, and with God's help, we will win together. We will return our hostages in the south. We will return our residents in the north. We will guarantee the eternity of Israel.
Okay, for more, Jemana Bezechi, our Horizons Middle East and Africa anchor, joins me. Jemana, map out for us at this point what Israel's response could look like.
Well, one thing we know for sure is that there will be a response, and that Israel, across all parts of the political spectrum, there is a need for retaliation. And you hear it from even Netanyahu's political opposition saying that Iran must pay a significant and heavy price. So then the question is, what does the reprisal look like? Now, if you remember back in April when Israel did respond to that first direct attack from Iran, it was very limited in nature. They went after military assets. They hit back then an air defense battery, and that was it. So this time around, the expectation is that they'll go for something more forceful. It could be in the form of further attacks on military assets. It could be in the form of covert assassinations. And of course, Israel never directly claims responsibility for the killing of Ismail Haniyeh, but there is talk that senior members of IRGC could be in focus. Now, as it pertains to markets, of course, there's been a lot of focus on them potentially targeting energy infrastructure. And just to give you some numbers here, Iran's overall production is around 3.4 million barrels a day. About half of that is exported to global markets. A city just put out a note now saying that if they wanted to hit specifically the production that goes to external, then you're looking about taking about 1.5 million barrels a day off the market. But if they target specific downstream sectors, so some of the processing plants, then the hit could be something akin to around 300,000 to 450,000 barrels a day. It's significant, but not as significant, of course, as taking all of Iran's supply off the market. And then the final option, and this is clearly an option that the U.S. don't want to go for, would be if Israel decides to go after some of Iran's nuclear sites. That would be the most extreme option. And even from the military standpoint, it's unclear whether Israel actually are militarily equipped to take or enact lasting damage on Iran's own nuclear program. So all of those are options that are being put on the table. But I should just emphasize at this point, we don't have insights into what Israel is thinking. These are just some of the options that are being discussed.
Okay, Jumana Basetchi with the details in terms of some of the potential moves that Israel could look to take in terms of its planned retaliation against Iran and, of course, the impact potentially on the oil markets as well. Jumana, thank you very much. Indeed, our Horizons Middle East and Africa anchor. Coming up, more of our discussion with the French President, Emmanuel Macron, and his backing of a temporary tax, and that's important, temporary tax, on the country's biggest companies. That's coming up. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Having an exceptional taxation on corporate is something which is well understood by large companies. If this is for 1 year, given the level of effort which should be made, but it should be limited, and we don't have to forget. I mean, we have not to forget the reality of our economy, the reality of our competitiveness and our position.
The French president, of course, Emmanuel Macron, speaking at the Berlin Global Dialogue on a panel moderated by Bloomberg's Stephanie Flanders. For more on that exclusive interview with the French president, let's bring in Bloomberg's Caroline Conin, covering, of course, all things France for us, joining us out of Paris. Macron then pushed on the domestic challenges that his new government is facing, Caroline. He made those comments around taxes on corporates. What stood out to you from what we heard from the French president?
So first, he is backing his Prime Minister, Michel Barnier, and his strategy to reduce the deficit and save 60 billion euros. And second, Macron is totally abandoning his idea of never raising taxes. We actually just heard from his former Interior Minister, Gérald Darmanin, saying he doesn't agree at all with this idea of raising taxes, because since the beginning, Macron has always pledged to lower taxes. Now, this tax on multinationals, we've heard from the Total Energy CEO saying this is unfortunate, but it's going to have a limited impact on Total, because anyway, they pay most of their taxes abroad. But there's another issue that's coming. Michel Barnier and the Finance Ministry yesterday also talked about possible green taxation and possibly taxation on the aviation industry. And that actually didn't go very well with the IATA Association, saying this could be a disaster for the French aviation sector.
And Caroline, Macron also asked about the EU tariffs. We're going to get some answer, we expect, on some of those tomorrow. But also that Draghi report, competitiveness, an issue that Macron has wrestled with himself. What did he have to say on those two fronts?
He actually doesn't agree at all with the German Chancellor, Olaf Scholz, on these two fronts. First, on the EV tariffs on Chinese cars, clearly Olaf Scholz wants to find some compromise, whereas Macron said he is supporting these European tariffs on Chinese EVs. And second, regarding the Mario Draghi report, Macron had a very pessimistic picture about the future of Europe and the fact that Europe is lagging behind the US and China. Have a listen.
Our former model is over. And this is not a question of adjustment. This is not the same world, 2024, 2025. And on top of that, we are making the same mistakes on top of the key elements I mentioned. We are over-regulating and under-investing. So just if in the 2 to 3 years to come, if we follow our classical agenda, we will be out of the market. I have no doubt.
Okay, some pretty frank comments there from Emmanuel Macron. Caroline Connard, wrapping up the context for us, joining us out of Paris. Caroline, thank you. Coming up, we'll look at OpenAI. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London, in for Francine Lacqua. These are the top stories. Europe's main indices slide this morning as China's record rally loses steam in Hong Kong trading. In Japan, the yen weakens as the new Japanese Prime Minister casts doubt on further BOJ rate hikes this year. Traders, meanwhile, adding to bets of a November rate cut after Bank of England Governor Andrew Bailey says he sees a chance of more aggressive easing. The pound slides to its lowest in a fortnight on those dovish comments. Meanwhile, in the US, President Biden warns Israel against attacking Iran's nuclear sites as he seeks to de-escalate tensions in the Middle East. The G7 considers ramping up sanctions on Tehran. Now, with a focus on technology, OpenAI has raised more than $6.5 billion in a new funding round, one of the largest ever private investments. The fundraising values the AI company at more than $150 billion. At this point, let's bring in Robert Lee, senior tech analyst from Bloomberg Intelligence. Rob, what do you and the team make of this deal, what it tells us about that appetite for exposure to Gen AI, and whether or not the valuation can really be justified?
Okay, well, whenever we discuss AI, it's superlatives all the way, isn't it? So I guess it shows that the demand for AI investments remains insatiable to some degree at the moment. As for the valuation, obviously it's a pretty punchy valuation for a company that remains loss-making at this point. But I guess the generic model within the internet and software sector as a whole is to build scale, to consolidate your position, and then look to push into profit some point later. As and when that may be for OpenAI, it remains to be seen, I guess.
Rob, meanwhile, on the question of valuation, I mean, maybe this plays into that debate. We're hearing from an MIT professor with renown in this space, Darren Acemoglu, and his comments to Bloomberg about AI only being able to do 5% of jobs. This is well worth a read, by the way. And the quote standing out for me, "You're not going to get an economic revolution," says this professor who spent a lot of time studying the space. What do we make of this?
Well, I have to say I'm really with him and more in his camp. And I think one key point I would make is I still think there's a mismatch of expectations here, if that isn't stating the obvious. I think there still needs to be a proper fundamental understanding, particularly in financial markets, about what AI is, what this technology is, what's actually driving it, what it can do, but more importantly, it can't do. And just 2 seconds, the basis of all AI that we see at the moment is pattern recognition. That's a very powerful technique that can be employed in many different end uses, will drive cost savings, will drive efficiencies. However, the current generation of AI that we see is not sentient in any way. It cannot think, it cannot reason. Therefore, that begs the wider, more philosophical question, which we don't have time to answer right now, but, you know, is this thing really intelligent? And I would actually argue and be in the professor's camp that, again, these algorithms and techniques are very powerful in some applications, but I think, you know, earlier concerns or in some areas of the press is sort of worries about AI taking over the world, triggering World War III, the rise in the machine. I think that remains within the realms of science fiction. So this is a powerful technique that has applications in some areas, but I don't think it's going to revolutionize the economy as we see it today. But it's, you know, we're an early step onto this journey.
Well, this is true. Look, Jensen Huang of NVIDIA may take the other side of that bet, of course, Rob. He's been talking about the demand for the latest Blackwell chip, so it's their latest iteration of the AI accelerator, their GPU. He says that demand is insane. What should we make of his comments in terms of what it tells us about the outlook for demand as we look into 2025?
Now, I thought that was a very interesting choice of words because, calling it insane, yes, absolutely. As we know, demand continues to outstrip supply. But also, is it insanely sustainable? Again, for people who've looked at the technology sector over the years, this is a sector renowned for bubbles and renowned for hype cycles. Are these comments going to go down in the annals as, a marker of perhaps peak AI euphoria? I think it remains to be seen, but again, going back to the professor's comments or whatever, I do think expectations are running ahead of themselves at the moment. This is a powerful technique, but it isn't going to revolutionize industries. And I think the level of monetization that these companies are generating at the moment remains at a very low level relative to the very high expectations that are being priced both within public markets and also private markets, with OpenAI being an example of that. So I think at some point there is a day of reckoning coming on that.
Okay, a day of reckoning. There we go. Robert Lee, maybe with some could argue a healthy dose of skepticism, or at least cynicism, maybe caution around what is happening in terms of Gen AI. Senior tech analyst from Bloomberg Intelligence. Rob, thank you very much indeed. We stay on this space right now because big tech is ramping up investment in European startups driven by this AI boom. The value of European VC rounds with big tech involvement increased to $3.1 billion just in the first half of the year, up from $545 million in 2023. That's quite the jump. That's according to a new report from Founders Forum. The group's CEO, Caroline Dawson, joins me now for an exclusive interview. Caroline, thank you very much indeed for joining us. This is the first report of its type that you and the team at Founders Forum have put out. And it's very timely, given the investment that we've seen into OpenAI from the likes of NVIDIA, from the likes of Microsoft, many others as well. The role that mega cap tech, that the Mag 7, that NVIDIA and a number of those players, Microsoft, Amazon, Meta, are playing and having in terms of reshaping this European startup scene. What is it looking like? What kind of impact are they having?
Yes, I mean, we're delighted to do this as the first report ever and really kind of garnering the insights from the founders themselves that are partnering with the big tech companies, which is, it's a critical part of the ecosystem. What we've seen is, phenomenal growth in the investment, fivefold for that first half of the year, but it's very concentrated to a smaller group of startup players. And actually over 99% of them have sort of said, we need more. And it isn't just around investment. They need sort of tangible and practical outputs to support them in their growth stories. The headlines really are that Google and Microsoft come out as the lead in innovation and in investments. Meta and NVIDIA lead in investments, perhaps less so. They need to raise more awareness in the programs that they're delivering. Amazon, really seen as the startup builder, probably the best reputationally across with the founders, but very much seen as the grassroots all-round player. And Apple, still work to do in terms of reputation and investment from the founder sentiments that we surveyed. Yeah,
really interesting that Amazon stands out as being possibly, at least from the view of some of these founders, the best partner there, which is really fascinating. Meta has been very acquisitive as well, so it stands out top of the list in terms of the acquisitions that it's made within this space. What's driving that? What's behind it? What have they been targeting?
Well, ultimately, I think people forget these are now major companies that need to innovate in the same way that perhaps, 100-year-old corporates do. That partnership really between the two is critical, and the pace of the AI, we just talked about the pace of change and the demand being insane. There is a requirement to keep that technology innovation at pace, and working with startups from the big players investing in those companies is just a critical tool for the big tech companies, as it is for startups to partner with them.
You've used the word critical, I think 3 times, Caroline, and probably appropriately so. But I wonder if critical is also an over-reliance. Is the European ecosystem around startups overly reliant on this US funding?
We need sources of capital from all forms, and that can't just come from big tech providers. And it isn't just really investment. What we've heard from the founders is they actually need the programs that these big tech companies are opening. We need proof of concepts and sandbox environments where actually the big tech companies play a role to bring together corporates, academics, scientists, and the startups to really look at the next frontier of technologies into climate, AI, and groundbreaking environments, really. So it isn't just around the investment, but of course investment's important, but we need it from multiple sources.
Is it also a reminder that Europe lacks that growth, later stage funding, the firepower when it comes to those big ticket investments?
I think there's never been a better time to be a founder in Europe right now. And generally, what we're seeing over the last few weeks and months is that really, actually, Europe is leading in the sense of some companies in AI, in voice, in video, in software tools. So we've probably been never in front of a technology curve as much as we have now, but we have to remain competitive. And so to continue that competitiveness against US and China, we do need more later stage capital. We do need that from multiple sources, and we do need these partnerships. And I think that sense of just investment in talent as well. So we've seen actually the European engineering ecosystem has really matured, but we need more around leadership at scale. And this is where the big technologies can really play, big tech companies can play a role in providing mentorship, providing partnership to help more later stage companies. They're more traditionally known for the grassroots and early stage, but how can they actually partner with these companies to help them come at scale?
I would imagine there may be some regulators in the UK, in Brussels, who'll be looking at your report and thinking, this is a reminder that there is a monopolistic, anti-competitive push coming through from mega cap tech. Now, that is not what you're saying in this report, but clearly there is a concern about the size and scope of these companies, hoovering up the startups and just expanding their moat that much further and making it a much more difficult place in which to innovate.
Yeah, I think it's no secret that the big tech companies are clearly quite distracted and focused on that EU digital markets.
Yeah.
And
is it a fair criticism, do you think?
I think we need to make sure that we've got a competitive and fair playing field for all. It's a bold move from OpenAI recently about saying, no competitive, investments from those. I think there's very few companies that can pull that off. Is that the right thing for a competitive market? Time will tell. But I think we need open and fair playing fields for these companies to grow and scale.
Okay, what are the capital markets looking like? Because you talk on scale, and that's another challenge for Europe. Scaling these businesses, getting them to sizable exits or IPOs, how is that evolving?
We need to see more across the pension reform. So now with the change of government, let's see how that transpires. We need to see more family offices and institutional families investing. I think in the ecosystem needs to come from multiple sources and not only believe that it can come from big tech players or US investors.
Okay, so we look for those additional reforms as well. Maybe we'll get some announcements around the budget. Talking of which, are you hearing any concern from the touchpoint individuals that you have, whether it's investors or founders, around what might come out in the budget, particularly with a focus on capital gains, carried interests, high net worth individuals? Is that something that's percolating to the surface in your community?
Yes, absolutely, but we don't know yet. I think really it's just a case of the fact that we need to make sure we stay competitive and have the right incentives and the right opportunities for founders to make the UK a brilliant place
carried
to
interest, capital gains could be a cold wind across this sector here in the UK.
I hope not.
Okay, Carolyn, being very diplomatic. Carolyn, thank you very much indeed. It's a great report, really worth reading, really insightful and very timely as well. Carolyn Dawson, CEO of Founders Forum. Coming up, the UK Prime Minister, talking of the UK, promising to stand firm in negotiations as he seeks closer ties with the European Union. We are live in Brussels on Keir Starmer's trip. That is next. This is Bloomberg.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back. 9:43 here in the city of London. The FX space, the currency to watch right now is the pound. On the back of this interview that the Bank of England governor has given to The Guardian, in which he said this: the BOE could become, quote, a bit more aggressive. We'll put up the quote for you, but look at the price action then on the pound. Down over 1% versus the US dollar, trading at 131. The pound falling over 1%. That's the lowest since at least September the 16th. Another superlative for you. The euro has strengthened 1% versus the pound. That's the highest level since September the 20th. So you're seeing that impact on the pound, and you're seeing a pretty marked impact as well in the gilt markets. Money moving in, yields down at the front end, yields down 7 basis points on the 2-year. You're comfortably below 4%, 394, and the benchmark 10-year adds out 4% on the nose, yields down 2 basis points. But the work being done at the front end of the gilt curve as money moves in on expectations now that the BOE will cut again 25 basis points in November. There's the quote then. If the news on inflation remains positive, there's a chance the BOE could become, quote, a bit more activist and aggressive in cutting interest rates. Andrew Bailey on the prospects of a more dovish Bank of England. Now, the UK Prime Minister has promised to, quote, stand firm during what are likely to be difficult negotiations to forge closer ties with the European Union. Keir Starmer made his first visit to Brussels as British PM yesterday, meeting with Commission President Ursula von der Leyen.
We are determined to put this relationship back on a stable, positive footing that I think we all want to see.
Bloomberg's UK correspondent Lizzie Burton is in Brussels and joins us now. Lizzie, I'm having flashbacks to the Brexit negotiations, but this time the tilt is different. We're talking potentially about a warming up, maybe a resetting, maybe a redrawing of UK-EU relations. How realistic is that?
Well, indeed, for the first time in a long time, the Union Jack was flying here at the European Commission yesterday, Tom, and Keir Starmer in the press conference told us that it's going to be very different. There isn't going to be a drip, drip, drip of leaks coming out of these negotiations. He wants to mark this as a different era from when the Conservatives were in power. But look, I have to say, this was an incredibly frustrating press conference from the new PM. Again, focused on the vibe, not on the detail. He says it wants to be a more pragmatic, more mature relationship with Brussels. And he says that changing the tone is important if you want to reset the relationship. But look, behind the scenes, even EU diplomats are getting annoyed at the lack of detail. And just as in the UK, you've got the UK newspapers filling the policy vacuum with stories about freebies and number 10 infighting. The policy vacuum here is being filled by EU officials who've got their own ideas for what they want from the UK. They want reassurances on fisheries and they want a youth mobility deal. That is what Ursula von der Leyen will be pushing for. Keir Starmer very clear that he's not going to rejoin the customs market or the single union or go back to freedom of movement, but interestingly not ruling out those two big asks from the EU.
Lizzie, explain for us, what is the controversy for the UK around a youth mobility deal? This is one of the biggest losses of Brexit, objectively, that you couldn't pick up your passport, travel and work in the EU after Brexit. But we're talking about students being able to do that to some extent. It's not about migrants, it's about students. Where is the controversy for the UK?
You're absolutely right. There is a key distinction between migration and mobility. This is what the EU officials are emphasising. They say, look, this is time limited, it's on a visa basis, and it's a particular demographic. But of course, for Keir Starmer, the danger is that it reminds people of freedom of movement, which is what Brexit ended. He does not want to go back to that. He cannot risk adding to net migration figures, even in the short term. Frustratingly for EU officials, they're looking at his majority in Westminster and saying, come on, where's the ambition? But potentially the way that this will get over the line is if they can change the way this appears in those migration numbers. So there is a way through potentially for Ursula von der Leyen to get something on the table with Keir Starmer.
Okay, let's see if they hoist up the Union Jack once again outside the Commission. Bloomberg's UK correspondent on the ground for us, Lizzie Burden, on the visit, of course, by Keir Starmer to Brussels. Lizzie, thank you. Now to the US, where US prosecutors say Donald Trump should stand trial for, quote, his private crimes in trying to overturn the 2020 election. The newly unsealed court filing alleges that when told that Vice President Mike Pence could be in danger at the Capitol during those riots, the former president replied simply, so what? The special counsel files come after the US Supreme Court ruled that presidents in many instances cannot face charges for official acts while in office. Coming up, as the EU prepares to vote on tougher tariffs for Chinese EVs, German car makers push back. We discuss that next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back. Mercedes has joined BMW in pressing Germany to vote against imposing significantly higher EU tariffs on Chinese-made EVs. That's as German car makers push to avoid a spat with their most important market. Meanwhile, we've been speaking to the vice chair of XPeng, one of the leading startups in the EV space in China. Brian Gu talking to us about how they're thinking about the potential tariff impact. Let's listen into Brian Gu, and then we bring in Craig Trudell, our cart czar, for the analysis. Let's bring in the Xpeng sound.
Being more local is not because tariff, is not only because tariff. Because as a company has aspired to be a leader in a market like Europe, we have to think about becoming more local. You know, we have to have more local team to build our local brand and also have more local presence. And also, you cannot rely on an export-only strategy to deal with a local market like such a big market like Europe.
Okay, Brian Gu there of Xpeng speaking to Oliver Crook in Berlin. At this point then, let's bring in Craig Trudell, our autos editor. Craig, so we're getting the response from the German automakers on one side, the Chinese automakers on the other, looking to maybe build out the capacity in Europe to try and weather this incoming storm, if that happens. What do we make of how this is reshaping the autos market and whether or not Europe will go ahead with these tariffs tomorrow?
It's a big risk for the industry because it's not just a matter of hurting some and you know, sparing others or even helping others. At least, you know, that's the case that a lot of companies are making and even some governments here. I do think that it's likely that the tariffs are going to go ahead. We've only seen you know, day by day, you know, sort of more justification for those in favor of these tariffs in the sense that you know, we're seeing more competition, tighter margins, threats of plant closings. All of these things sort of feed into this narrative of, you know what, maybe we shouldn't be so open to the Chinese manufacturers that have so much capacity and have big ambitions to grow here. If they want to grow here, they need to build here. And also, you know, we need to do something to protect our sort of homegrown companies.
Okay, briefly on Tesla then, it's part of the story here as well. What is Tesla looking like now in terms of deliveries, the numbers coming through from Tesla?
Yeah, yesterday's deliveries, it was the first year-over-year increase of the year for them. It was a little bit lighter than some analysts were expecting, and we did see a big run-up in the stock in the weeks leading up to this report. So I think a little bit of a letdown. They too will be affected if tariffs go into place because they're relying on their plant in Shanghai for Model 3 supply here. So they too are looking at next, you know, at tomorrow's vote with some trepidation of impact for them in the months to come.
Yeah, significant day then for the sector. And we hope to bring your expertise back to unpack that for us tomorrow ahead, of course, of that decision. Bloomberg's Auto Czar covering all things autos for us, Craig Trudell with the details there. Up next, it is Bloomberg Brief with Manus Cranney in New York, standing by as US futures point lower by 0.4%. The down day as well here in Europe. European stocks down 0.7%. Stay with us. This is Bloomberg.
Hey, ChatGPT.
Hello there. How's it going?
It's going really well. Today, I'd really like your help solving a math problem.
I'm all ears. What math problem can I help you tackle today?
So I'm going to write down a linear equation on a sheet of paper, and I'll show you. And then I'd love your help working me through it. But importantly, don't tell me the solution. Just help give me hints along the way.
Got it. Okay, I see it.
No, I didn't show you yet. Just give me help along the way. 1 second.
Whoops, I got too excited. I'm ready when you are.
So, ChatGPT, what equation did I write down there?
Ah, I see it now. You wrote down 3x plus 1 equals 4.
Yep, exactly. So what's the first step I should take to try to solve this?
The first step is to get all the terms with x on one side and the constants on the other side. So what do you think we should do with that plus 1?
Okay, I'm going to try to subtract 1 from both sides, and then I'll see what I get.
Great idea. Perfect. Now, what do you get when you subtract 1 from both sides?
Okay, so ChatGPT, this is what I ended up with. How does this look?
Spot on. Now you've isolated the term with x on one side, and it looks like 3x equal 3. What do you think we should do next to solve for x?
I'm not sure. Can you give me another hint?
Of course. You have 3x, and you want to find the value of x. Think about what operation would undo multiplication.
Is it subtraction?
Close, but think of the opposite of multiplication, because 3x means 3 times x.
Okay, I think it's division. Let me try to divide both sides by 3, and let me see what I get.
Bingo! Go ahead and divide both sides by 3.
Okay, so ChatGPT, this is what I ended up with. How does this look?
It looks perfect. You've solved it, and x equals 1. Nicely done. How do you feel about solving linear equations now?
Yeah, honestly, I'm not pretty confident I can solve linear equations, but why would you ever need to use this in the real world? I'm really skeptical.
That's a fair question. Linear equations pop up in a lot of everyday situations, even if we don't realize it. For example, calculating expenses, planning travel, cooking, and even in business for profit and loss calculations. It's basically a way to solve problems where you need to find an unknown value. Plus,
Wow,
it's...
okay. You know, I have a lot of unknown values in my life. I'm totally convinced I'm gonna learn math now.
I love that attitude. Math can definitely help solve some of life's mysteries. Whenever you're ready to dive into more math, I'm here for you. Anything else you'd like to tackle today?
So ChatGPT, I really love that you taught the value of math to my friend Mark. And I wrote one last thing I'd love if you could take a look at.
Of course. I'd love to see what you wrote. Show it to me whenever you're ready.
Okay, so this is what I wrote down. What do you see?
I see. I love ChatGPT. That's so sweet of you.
Yeah, well, I really appreciate all the help.
It says Blackwell chips are well on track. OpenAI raises funds to the value of $157 billion is the valuation on OpenAI. A very good morning to you. We have some restraint in these markets, in the equity markets this morning. To what extent did the ADP number popping at 143,000 indeed deliver a little bit of a flesh wound to the 50 basis point cut? Nvidia is up 0.6%. The demand for Blackwell is insane. So stocks in the first instance just on the back foot. Yields popped, stocks dropped. We definitely are on conflict watch in the Middle East. To the bond market, let's roll it over, have a look at that. Of course, the bond gains have been unraveling, as I say. The narrative around a 50 basis point cut was just slightly, ever so slightly undone yesterday on the ADP numbers. We count down to the jobs numbers tomorrow and the jobless claims today. By the way, Royal London Asset Management's Trevor Greetham warns of a bloodbath next year in the bond market. So that is certainly something to consider. A little bit of breaking news for you on the PPI in Europe, in the Eurozone, comes in, it falls to 2.3% year on year. The estimate was for 2.3%. That is the year on year number. Let me just give you the actual month on month pips a little bit higher to 0.6% from an estimate of 0.5%. So those are the very initial take on the euro dollar there. As you can see, fairly flat at the moment. The CPI was the real needle moving agenda in the Eurozone this week. Well, the Bank of England Governor, Andrew Bailey, is striking, some would say, an aggressive tone on the rates market, saying to the Guardian newspaper this: if the news on inflation stays positive, the Bank of England could become a bit more activist in cutting rates, currently standing at 5%. Joining me now is Jill DeCease in terms of the rates market. I look at this rates market, there's comments as well from Ishiba. But if I look at sterling and yen, Jill, I've got a dovish pivot potentially from a gradualist Bailey, and I have restraint from a hawkish Ishiba in Japan. Good morning.
Good morning. Yeah, well, look, I think let's start with Bailey, right? This is a bit of a pivot, obviously, from this more of a steady as she goes, gradual approach from the BOE there. So I think it's really that language that you just cited there, a bit more activist, bit more aggressive, that has markets, starting to price in not just, pretty much fully price in a cut in November, but also start to price in a chance of another cut in December. I mean, look, I think this is kind of reflective of the direction of the global economy right now. You're seeing a lot more resilience within the global economy. Inflation also coming down, quite a bit more. So that's giving central banks like the BOE more room to sort of, start, getting a bit bolder with, making these statements about cuts. We can talk more about Ishiba in Japan. I think that's really, the more jolty comment here, a bit more unexpected, coming in from this new prime minister, sort of speaking. It feels like, is it on behalf of the BOJ there, or what have you? But yeah, I think those are certainly more interesting comments because of how much that flipped, and has a lot of people that were expecting a rate hike in Japan by the end of the year, and now having second thoughts about that.
Yeah, it's interesting because I'm looking at various research houses, and they're saying from Daiwa, for example, it's to try and soften the Ishiba shock. And he's basically saying the economy isn't ready for another rate increase. Do you think he's learning the reality of leadership and politics?
Yeah, look, he's kind of a self-described defense nerd. Remember, this is a guy that, when the LDP leadership elections were happening just last week, it was kind of a shock that he, was even put in this position in the first place. Now it seems like he's kind of learning how the markets are moving. We saw off the back of his election at the end of last week, the yen advanced, but you saw stocks fall in Japan. Maybe this is an attempt to kind of figure out how to reassure markets there. He's making these comments just after he came out of a meeting with BOJ Governor Ueda. Is this a case where maybe the new, incoming prime minister has to, kind of figure out how exactly to work with markets or kind of massage some of that language to avoid these kinds of jolts in the future? Could just be maybe a very a valuable learning lesson for him as he comes in.
Well, we're certainly feeling our way into this new regime, from the Fed to the ECB to what happens with the BOJ and the BOE. Jill, thank you very much. Jill DeCease on the very latest rates narrative from the UK and Japan. Here in the US, traders are paring back their 50 basis point cut bets, and it's on the back of yesterday's ADP jobs data. The Apollo CEO, Mark Rowan, spoke exclusively to Bloomberg. This was before the data, I should say, but he did have a warning shot on aggressive rate cuts.
The notion that we would cut rates, financial markets are wide open, equities are at all-time high, financing is available, real estate prices are going up in every market, and yet we're stimulating. And we're stimulating fiscally. It is not clear that we need more rate cuts at this point in time.
Callum Pickering is my guest this morning, chief economist over at Peel Hunt. Mark Rowan there with Jonathan Farrow. Great interview. Rowan says this was a very expensive insurance policy cut. That's an interesting take from the rest of the crowd that are saying this was just holding things steady.
Well, look, I think if the Fed could be honest with markets, it would have probably gone 25 basis points a couple of months earlier and would have found itself in probably a better position. The question is now, now that the Fed has set such a low bar for 50 basis point cuts, what price will it have to pay in the future? I'm, of course, nervous heading into tomorrow's jobs report. If the unemployment rate ticks up, I wouldn't be surprised if markets shift back towards expecting 50 basis points, and then it's a question of how the Fed might react to that. I largely agree the US economy is strong. I don't think there's a justification for going 50 in the next meeting, but I do think there's a justification for taking funds rate towards neutral. Now, Fed members seem to think that neutral rate is 2.9%. I think that's a little on the low side. I think we'd be less concerned about potential inflationary risk from aggressive Fed easing if the Fed just came out and said, actually, we think that the neutral rate's a little bit higher. So if we were aiming for, say, a 4% funds rate and the Fed were to get there over the next few meetings, I think markets would be relaxed. There'd be fewer two-sided risks around the next calls.
Look, you have consistently talked about this risk of reflation or a spike in inflation. And again, continuing on from that conversation at Apollo, the risk in 2025 is that we don't get to this 190, 200 basis points of cuts, which Larry Fink says is crazy.
Yeah, I think that's probably too much. Even if the US economy has a cyclical mid-cycle slowdown over the next couple of quarters, which I think is likely, 100, 150 basis points of Fed cuts should be enough just to bring the momentum back into the second half of next year. I don't think we really fully appreciate, and central banks have not yet appreciated, just how much different the world is today versus pre-pandemic. I'm a Brit, so I'm allowed to say this, but I think we've had a Keynesian moment. The economy was sleepy before COVID. We gave everyone a rest. We had lockdowns. We juiced the economy up with fiscal and monetary policy. Since we've opened up, we've released an almighty amount of economic energy, and lots of things have normalized. We're much more aggressive in wage and price negotiations. We've reacted well to higher interest rates. And so I think central banks have to be cautious about not returning to that ultra easy mindset. If they go too far too fast, it's quite right that we should be nervous around inflation risk next year. And again, that's the price I think the Fed may end up paying for going a little too aggressive on the first move.
I was reading some of Marco Papek's research from GeoMacro, and he said what we do is we pivot from a cash-induced economy, which was all the COVID stimulus, to a leverage-induced economy in a rate-cutting cycle, and that has tail risk.
Look, I think we should just be clear here. There's a big difference between lowering interest rates and having easy monetary policy. Easy monetary policy is when the Fed gets the rate below neutral. So for me, the question is, where is neutral? I think it's higher than the Fed is signaling. For me, that's the key point. I think if we can get rates to say 4, 4.5, I don't think we need to be too concerned. Of course, it depends a lot on what happens with fiscal policy after the election. But I think once we start getting below 4%, I think that's when you should start to worry a lot about credit cycles inflecting upwards, about potential inflation risks heading into the second half of next year. But in a way, we're back to a more business cycle environment. We're back to a degree, a bit of boom bust, where central banks ease a little bit too much, they tighten a little bit too late. This is par for the course in a normal economy. It's just unfamiliar because we haven't been here for so long.
Well, one country which is delivering stimulus in familiar style and fashion is China. That combined with synchronized global rate cuts, what do you first of all make of the quality of the stimulus from China, and what does that do to the growth narrative?
Well, China has structural problems. Short-run stimulus will not solve structural problems. We roughly know what the playbook is for real estate corrections, for financial imbalances. We saw this in Japan in the 80s and the 90s. We saw this in Europe and the US in the mid-2000s. This takes a while to play out and to fully fix, but we definitely see a sense of urgency with the China policy response in response to the weakening growth momentum in the first half of the year. So what I think we're looking at here is near-term downside risks. The fact that they've reacted suggests that on the ground things are not good. But if you add up the Fed stimulus, the China stimulus, the fact that Europe is probably edging towards a quicker pace of rate cuts, altogether this means industrial production, global trade is probably likely to pick up into next year. And that's been the missing part of the upswing so far. Even in the US and the UK, where you've had strong momentum this year, it's almost entirely services driven. Europe has been weak because trade has been missing. Asia has been weak because trade is missing. And the global market is actually signaling that production and trade will be heading higher. If you look at the Dow on a year over year, for some 3 months, it's been leading trade and production higher. So I think next year, it's the upside risks that are more likely than the downside risks, judging by this synchronized stimulus.
I mean, we're counting down to jobs day tomorrow. We had the ADP numbers yesterday, which was adding jobs, perhaps with a little bit less heat in the wages component. Do you still think that the Fed is correct in their assessment of a fairly tempered, well-tempered level of unemployment, 4.2, 4.4 at a stretch?
Well, I certainly hope so. I don't see much of a risk that, at least judging by fundamentals, that U.S. employment can take a lot higher, and by a lot, I think we remain below 5%. The problem I have is, if you look at some of the signals in surveys, take the Conference Board signal, the difference between hard to get jobs and easy to get jobs, that's signaling a little bit of an uptick. And if I look at the consensus of economists for tomorrow, no one is expecting the unemployment rate to tick higher than 4.3%. So even if we got a 4.4, just an 0.2 percentage point move, that would come as a surprise. And so we're really in a market where the mixed signals on the economy are making it very difficult to predict month-by-month data. At the same time, you have the potential for global supply shocks coming from U.S. port strikes, coming from the escalation in the Middle East. I think it's going to be difficult for the next few months to get a proper read. But again, my hunch is this synchronized cutting cycle is going to lead to a sizable recovery heading into next year across major parts of the world.
And that's where we pivot from soft landing to no landing, and that seems to be a building consensus. Callum, thank you very much. Callum Pickering there of Peel Hunt. Other stories trending on your Bloomberg terminal this Thursday morning. This is what we've got for you. NVIDIA extends its jump higher. That's in the after-hours trading as the chipmaker CEO Jensen Huang said in a CNBC interview that demand for the company's Blackwell chips is insane. The comments come amid concerns about engineering snags that delayed the release of the Blackwell chip. That Huang said yesterday that the chip was in full production. And it's another week where Warren Buffett has trimmed his holdings in Bank of America. Share sales this week fetched around $330 million. The pace of Berkshire Hathaway's offloading of the stock in the bank does seem to be slowing as its total holdings approach 10% regulatory threshold. Buffett hasn't said why he's paring the stake, but the firm remains the bank's top shareholder. LVMH and Formula One have signed a major 10-year sponsorship deal, potentially worth $1 billion. The French luxury group has used Rolex's spot as one of the race's top sponsors. LVMH is upping its presence in the sporting world after being a major sponsor of the Olympic and the Paralympic Games in Paris this summer. Coming up, Middle East tensions persist, oil rises, traders assess the supply risks. We discuss on Bloomberg. And a little bit later this hour, we speak to Aaron Kennan of Clear Harbor Asset Management on his outlook for the fourth quarter. Context matters on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
We are still very much at the bottom end of the range here in crude. This is not a market that's panicking too much about what will happen if there is a supply disruption, and that's because they are focusing on the OPEC plus spare capacity that's sitting on the sidelines.
That was Rebecca Babin of CIBC Private Wealth speaking to Bloomberg yesterday on the outlook for oil. We're bid again for the third day in a row. The world is bracing for what the retaliatory action from Israel against Iran will be. Supply uncertainty mounts as OPEC is making no changes to its plans to start gradually reviving production despite the impending surplus. There's a lot of conflicting views in this oil market. Paul Wallace is with me. Paul, I look at the oil market. It's bid, but it's not exactly on a major conflict footing. And this will come down to what Iran does, potentially to the oil infrastructure within Iran. What would that do? It's the export facilities that we're perhaps most focused on.
Hi, Manus. Exactly. It is bid, but it's not up massively. I think we're up about 3.5% when it comes to Brent this week. But still below $75 a barrel and still below where it was in late August, early September. We are seeing a bit more action in the options market, and there do seem to be quite a few more buyers of $100 call options, for example. And call options are now becoming, they are now more expensive than puts again. But as you said, the market will probably react more once it knows what Israel's response is to this barrage of missiles that Iran fired at it on Tuesday evening. It is possible that Israel decides to strike Iranian oil infrastructure, and I think that would possibly lead to the first energy supply disruptions from the region since October the 7th last year, when these various conflicts in the Middle East started. There's pretty much been nothing that's directly hit supply since then. But if Israel decides to go for Iranian oil infrastructure, be it refineries or export facilities, then yeah, I think that could really worry oil traders.
I mean, I look back when the Houthis hit Saudi infrastructure, and on that day, oil ratcheted by 20%. So we are nowhere near there. I think the risk for this market is, of course, as you say, the options market is bid. It's on the supply side, and OPEC is ready to put more supply back on the market. But the Journal article about $50 oil, it looks like OPEC are refuting that.
Yes, it does seem like they are refuting that, and the signs are that the OPEC Plus is going to continue with its plan to bring back some of that spare capacity that it has in December. So it doesn't look, according to a sort of meeting that some of its officials had yesterday, that they're going to pull back on that. So they are well aware that demand is under a lot of global demand is under a lot of strain at the moment, and there is quite a bit of supply growth from outside OPEC Plus at the moment, and 2025 looks like it's going to be an oversupplied oil market. But nonetheless, they seem like they're going to go ahead with their plan to boost supplies starting from December. But just to stress again, I think it is possible that things change once Israel makes known what it's going to do. And a lot of people think we'll find out in the next few days.
Indeed. Well, Biden has made it clear when he was asked yesterday in regards to supporting attacks on nuclear infrastructure in Iran, the answer to that was definitely a hard no. Paul, thank you very much. Paul Wallace tracking the oil story for us. Coming up on the show, we'll look at what else are making headlines around the world for you. We'll take a look at the front pages.
Thanks, guys.
And the very latest on the destruction from Hurricane Helene. Context matters on Bloomberg.
We invest in, buy, and own the backbone of global economy. when the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's a Bloomberg Brief. I'm Manus Granny in New York. Time for the front pages. These are the headlines from around the world. First up, we take you to the New York Times. The U.S. District Judge unseals new evidence in the federal election case against Trump. When the former president was told that his then Vice President Mike Pence was in peril as the January 6th rioting escalated, Trump replied, "So what?" Other accounts were revealed on Wednesday in a court filing, which the special counsel made his case for why Trump is not immune for prosecution on federal charges. Washington Post leads with Biden and Harris visiting the storm-ravaged areas from the air. 1,000 troops have now been deployed. The death toll has risen to 183 people. The destruction is expected to cost insurers around $6.4 billion. Here's what President Biden said, approving the federal aid package yesterday.
Today, I approved the request of Governor Cooper for the federal government to cover 100% of all the costs for debris removal, emergency protective measures for 6 months, all the costs.
And on Bloomberg, we give you a little bit of private equity and sport. Miami Dolphins owner Ross Neers selling stakes to Ares and Side. Properties include Hard Rock Stadium, Miami Grand Prix for Formula One, and the sale could value the team and other assets at around $8 billion. Or we go to Miami. I mean, the NFL are smart. No single fund can invest in more than 6 teams, and they can participate on the upside. Jobless claims are on the slate today. We'll push ahead with the agenda with Aaron Kennan from Clear Harbor Asset Management.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our global headquarters in New York, I'm Menace Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Labor strength, Treasury slide as investors weigh the latest jobs data. Jobless claims and services PMI on deck today. Middle East on the edge. Oil climbs for a third day as Israel strikes Beirut. President Biden urges proportionality from Israel. And AI wins. NVIDIA's Jensen Huang says Blackwell chips are well on track. OpenAI raises funds to value the firm at $157 billion. Good morning. We are on the back foot this morning on equities. We're counting down to the jobless claims today. You had a little bit of a pop in yields yesterday on the back of the ADP numbers. Rubner over at Goldman Sachs warns, however, that his 6,000 target on the S&P 500 by the end of this year might be a little bit too low. So there's still some bullishness out there. NVIDIA is up 0.7% this morning. A little bit of a stronger action in the after hours yesterday. Demand for the Blackwell chips is insane. We'll talk more to our colleagues about that in just a moment. The bond market, look, the gains unraveled ever so slightly when we saw that hotter print on the ADP. Suddenly people do see a correlation, a higher correlation between ADP and the non-farm payrolls. Yields up ever so slightly this morning, up at the short end of the curve, up by 1 basis point. What does it take from the non-farm payrolls to reignite a real 50 basis point cut risk? By the way, Trevor Greetham over at Royal London Asset Management warns of a bloodbath in these bond markets going into next year on fiscal issues and on the resurgence on inflation. Well, overnight in the Middle East, another Israeli strike on southern Lebanon, which the Israel Defense Forces claim have killed 15 Hezbollah fighters. This as the U.S. urges Israel not to attack Iran's nuclear facilities in retaliation for this week's missile barrage. President Biden says he plans to speak to the Prime Minister, Benjamin Netanyahu, as the G7 allies plan further sanctions on Iran. Here is what the president had to say on Israel's response to Iran.
Obviously, Iran has gone way out of, is way off board. We'll be discussing with the Israelis what they're going to do, but all 7 of us agree that they have a right to respond, but they should respond in proportion.
Joining us now is our senior reporter in Dubai, Henry Meyer. Henry, the question is the calibrated response from Israel to Iran, and also the timing and the targets. Yesterday, I had Anna Rosenberg with me from a Monday, and she was saying, look, this could be a moment where Israel goes after the nuclear facilities because they have got American backing. But that politically would be hard here, and you heard from President Biden himself. It's a hard no on that.
Well, that's exactly right. We know that Israel has been, itching to launch an operation to try and dismantle as much as possible Iran's nuclear program. But we see from the U.S. statements that the Biden administration is adamantly opposed to that. Having said that, Israel has ignored the advice of the U.S. So many times in the last year since this conflict started. However, it would require U.S. assistance for that raid to be done effectively. So, I mean, a lot of the reports are indicating that the most likely target would be Iran's oil infrastructure, refining and oil export facilities.
Does that then raise the specter of a response or via its proxies in that crunch point, the Strait of Hormuz, if they go after the oil export facilities, suddenly we're talking about a new escalation in oil infrastructure around the region, aren't we?
Well, of course, that's the great concern. I mean, we have, countries like Saudi Arabia and the United Arab Emirates, which are, at the moment, are really trying to do everything they can to dial back the tensions. But there's, very little influence they have. Really, no outside players at the moment are really able to put a stop to this. But clearly, it will depend on, the extent of the damage that's done in these strikes, which we expect to happen within the next few days, and on how Iran decides to respond.
It should be said that the Saudi foreign minister and the Iranian president, Pezeshkian, they met in Doha, so the discussions go on in Qatar in the background. Southern Lebanon, let's get to the images that we're showing at the moment. What is happening there? There's been more strikes from Israel into southern Lebanon.
Well, I mean, yesterday was a significant day where we had the first fatalities among the Israeli soldiers who went into southern Lebanon on Monday. 8 soldiers were killed yesterday. And, we can see that Israel is accelerating its operation, its military operation inside southern Lebanon, and, with more airstrikes as well in the center of Beirut. So we see an escalation there.
Okay, Henry, thank you so much. Henry Mayer with the very latest on the Middle East. Clare Harbour's Aaron Kennan weighs in on the geopolitical risks with this. There are additional great powers that could enter the fray, and there are military mistakes that can occur, which could really create a tinderbox with a huge military, economic, and further humanitarian consequences. Aaron joins us now. Listening to Henry, Aaron, given the context of what you say, I just want to understand, what's the scale of retaliation that really shifts us from a sense of complacency in these markets to a material risk-off?
I think the markets, Manus, are right now of the view that this is a traditional Middle East skirmish, and it could very well be that way. What I mean by that is that markets could be temporarily volatile, but as you're seeing with the oil markets, we're not seeing any major spikes, and that suggests that there's quiescence on the capital markets front as it pertains to, sort of a fat tail risk that, you have a nuclear country in Israel that has significant capabilities, and you have an emerging nuclear power in Iran and an ideology at the top that has gutted their own country economically. And then, of course, you have 30% of global oil moving through the Straits of Hormuz, even though Iran's only about 4 or 5% of that capacity. And so there is a tinderbox opportunity, unfortunately, for this to go economically and from a humanitarian perspective, a little more pear-shaped. But Iran is sort of alone right now in the Middle East. You just mentioned Saudi Arabia. We don't hear much about Saudi Arabia as it pertains to what Israel's doing. And I think Iran is alone, too, because you don't see China involved in what's going on there. And Russia's obviously on their heels dealing with things up in Ukraine. But they funded the Houthis in Yemen, and that has disrupted our economic flow of shipments around the world. They've disrupted peace in the Gaza through Hamas, and now we were seeing in southern Lebanon, the only reason why Hezbollah is so consequential there is because Iran at the top has funded them. So they've done their people a real disservice, and I think economic opportunity could be brought to Iran if things were to change there, for sure.
And therein lies the point. They want to try and restart nuclear talks. If you look at it from the political prism here in the United States of America, Biden's faced with 2 pretty unpalatable options. One is supporting attacks on oil infrastructure, and certainly supporting a attack on nuclear sites. Neither of these are politically what this administration wants to deal with right now.
Yeah, I think it's challenging right now for the Biden administration. I mean, I think clearly the United States citizenry sympathizes with the democracy that is Israel and them having the ability to defend themselves. And there's an election coming up, and you have key battleground states, particularly Michigan. We have a large Muslim population that sympathizes with some of the issues that are occurring in the Middle East right now. And so the Biden-Harris administration is clearly aware of that, and it's really a conundrum of sorts for them.
Are you making any tactical hedging moves on the risk? I mean, we look at a huge amount of option activity on $100 oil. A lot of action preparing for that outlier risk. Any tactical moves by you or any restraint by you in deploying risk at the moment?
I think it's maybe a bit of restraint from the perspective that if volatility were to rise further from here, and we've seen that really since the end of the third quarter, volatility in markets have risen across the fixed income landscape, across the equity landscape, and they haven't, other than China, to a great extent, equities haven't been able to really move higher. And so when that happens and you have volatility, hedge fund managers, institutional managers tend to de-risk their positions. And so as long as there's, rising uncertainty, I think it's going to be difficult for markets to get out of the way here. And of course, you look at valuations in the equity market, and they look a little extended on a forward basis. But of course, that forward PE multiple is heavily represented at the top with Microsoft, NVIDIA, and the likes of those high growth sectors. If you look beneath the hood, there are other opportunities that we see across the landscape within the economy that are worth taking a look at.
Where are those biggest opportunities? I know you looked at the Russell, the small caps. Obviously, it's done very well in the third quarter, up 9%. I suppose the question is, does that rotation continue? Is that where the biggest opportunities are?
Well, I'm not sure if it's small versus large. I mean, certainly we're always looking at well-managed companies that are in areas of economic opportunity where the economic growth looks like it's sloping upward and can accelerate. It's all about rate of change. But, in the United States, one theme and around the world that we're seeing is the surging sort of electricity demand component. And that electrification that needs to happen due to the growth of data centers, the emergence and growth of large language models and artificial intelligence. And so there are lots of industrial companies in Europe, in the United States, that are very focused on that, whether it's battery storage technology, whether it's just sort of the more traditional industrial electrification processes. You saw a week or two ago Constellation Energy cutting a deal with Microsoft. We actually have the utility sector in the United States through the third quarter outperforming the technology sector. I don't think too many people know that because the utility sector represents such a small weighting in the overall index, but there are huge opportunities there. We're seeing private equity really become more democratized very quickly here in the United States. We're seeing this as an asset management firm, as a wealth management firm. There are opportunities in that landscape around private credit and private equity, not just to invest in those things, but invest in companies that offer those products. They're publicly traded. You had Apollo's CEO on yesterday. That's just one example of that. And of course, with uncertainty geopolitically, we have defense spending, both home and abroad. And I think that's going to become much more of a nationalized focus, too. You heard Emmanuel Macron yesterday talking about how Europe has to take care of Europe. And I think a lot of that also will mean that dollars or euros will accrue to defense companies based in Europe for the purposes of defending Europe, as one example, too.
Yeah, I mean, he is fairly visceral about the state of play in Europe. We didn't actually get to OpenAI raising $6.5 billion, giving them one of the best valuations, one of the biggest rounds that we've seen. Very quickly, what does that say to you about valuations right now? $6.5 billion, values OpenAI at $157 billion. It's one of the highest valuations we've seen.
Generative AI, they're the leader. ChatGPT, OpenAI, Mr. Altman is doing great things. It's about rate of change. The growth is unbelievable. The penetration rate over such a short period of time speaks volumes to the opportunity set. And so I haven't looked under the hood at the valuation per se, but at a macro level, it seems like there's a huge tailwind for AI. There'll be a lot of winners. There'll be many losers. And as investors, we'll have to try to sort that out in the weeks, months, and quarters ahead.
I think what's interesting with that, and we'll finish with this, is that the FT runs with the story, is that they've asked their investors not to invest elsewhere. That's what you call exclusivity. Aaron, thank you very much. Aaron Kennan, Clear Harbor Asset Management. I guess this morning on the markets. Good morning from New York.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon, in Sudan, and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Manus Cranny in New York. NVIDIA stock is rising pre-market. Jensen Huang said the Blackwell production is underway and demand, get this, is insane. This was an interview yesterday. Joining me now is Tom McKenzie. Tom, good to see you. This is what the bulls want to hear. It caused trepidation at a conference a couple of weeks ago in terms of the unsteadiness of Blackwell. Good morning.
Yeah, look, they've had some production hitches along the way, but this was pretty clear coming through from Jensen Huang in this interview, has to be said with CNBC, saying, look, there is this insane demand for our GPUs. That the production of the Blackwell, which is their latest iteration of their AI accelerator, is moving at pace. And it absolutely, Manus, to your point, is key for investors. Is the demand still there? How far does it take us into 2025 and beyond? How elastic is that demand? Can they match, can they supply and produce enough to be able to match that demand? Because so far that's been a challenge for NVIDIA. Is any of that CapEx spend from the hyperscalers cooling? I was speaking to Neuberger Bergman earlier on my show. They said they're seeing no signs of that whatsoever. They see signs of that demand continuing. That seems to chime and mirror what we've been hearing then from the CEO of NVIDIA.
And Tom, we've got to talk about OpenAI. They announced their new funding. It's the largest ever private investment, and the who's who, the royalty of investing, turned up. And Microsoft pitched in with a couple of dollars as well.
Yeah. Yeah, they did. Look, building on that $13 billion that they've already built into OpenAI, of course. So they were in the mix. It was a who's who's. It was star lineup, of course. I mean, who wasn't in the mix is a bigger question. NVIDIA was there, Microsoft was there, and of course, Thrive Capital, who've been leading the charge in terms of some of the bigger ticket investments into OpenAI. And as you pointed out earlier, Manus, really interesting that they pushed for this exclusivity because it was so overly subscribed. They had leverage. The CEO, Sarah Fryer, the CFO of OpenAI, and the team there pushing for that exclusivity from an investor saying, look, don't back the likes of Anthropic, don't back the likes of XAI. The rationale may be this: data sensitivity, IP protection, in terms of the eyeballs that the VCs will have on that kind of data and the concerns that it's going to feed back into some of their competitors. But it's also potentially going to ring alarm bells with regulators, whether it's in the US or in Brussels, who are concerned about what many may see as slightly anti-competitive, maybe a monopolistic traits coming through from OpenAI. That could be an accusation that could be leveled at this business. There is a concern, certainly in Europe, about the role, the size and scope of some of these big players in terms of hoovering up that market share, and this may do little to assuage that concern. And you can expect as well, likely, a comment from Musk, who's already suing OpenAI and now is going to be hearing that XAI, his AI company, has been told from some of the VCs, don't invest there if you're investing in OpenAI.
Yeah, it's only going to be fisticuffs at Dom, verbal fisticuffs at Dom. We'll give you your allocation, but we want you to be involved. We don't want you to be involved in a meaningful way in the business. We want you to be involved in a meaningful way in the business, so you can't commit to our competitors. Tagline for the prospectus. Tom, thank you very much. Tom McKenzie on the very latest on OpenAI and NVIDIA. From San Francisco to Miami, the NFL's Miami Dolphins owner, Stephen Ross, is said to be in talks with Ares Management and the billionaire Joe Tsai to sell a stake with a valuation on the company of over $8 billion. That is according to our sources. Charlie Wells is tracking this story. It's a cracking story, isn't it, Charlie? I mean, what did he pay for this? Stephen Ross paid $550 million. That was 10 years ago. And it looks like this is a very rich deal.
Manus, I mean, these teams have appreciated significantly. I believe since 2020 to 2023, the average appreciation is about 70%. But as far as this deal, I mean, it would mark a pivotal moment in NFL history because it would be the first PE transaction, or at least a transaction involving private equity, since the league approved institutional investors to come in at a rule change meeting in August. Now, as far as what is potentially for sale here, what we know is this would include stakes in the Miami Dolphins. This would include the Hard Rock Stadium where they play, as well as F1's Miami Grand Prix. So a combination there, and that could potentially go to Ares Management, the private equity firm, and as you mentioned, Joe Tsai.
Indeed. The question is, how likely does this go through? As you say, it's a pivotal moment. When you look at what the NFL have done in terms of regulating this, no single firm of any of these people that they've approved, no single fund can invest in more than 6 teams. The NFL gets to participate in the upside. So they've got a real vested interest in helping this deal through, haven't they?
They certainly do. I mean, they want to set the marketplace. They want to make sure that the valuations for these teams following this rule change make sense and that they start to take shape. You know, these are long-term, difficult-to-value investments, and they want to start to kind of clear that marketplace. The NFL, as well as a lot of these family-based owners, want investment as well. You know, it's been increasingly difficult to, you know, get state and local funding to pay for stadium upgrades. So bringing in some of that private equity money is, you know, could be very positive. And something else we need to talk about, and we started talking about this appreciation, is a lot of these family owners are getting older. They want some help offsetting the potential tax hits that they face.
And, you know, in terms of this entire regime shift and this industry, this is just step one in terms of these deals, isn't it?
Manus, that's a really great point. This really is just step one. I mean, the NFL has long been, you know, very closely held. These are kind of mom and pop businesses, if you think about it, with, you know, family owners, local celebrities owning these teams, former players. They've had some of the strictest ownership rules in the world of professional sports. And so allowing in those institutional dollars, that could bring a lot of changes to the way that this league functions. We know mom and pop owners, local celebrities, they've got certain interests when you bring in these private equity firms when we bring in institutional money, the interests change significantly, and they are focused a lot more on the bottom line.
Okay, Charlie, thank you very much. Charlie Wells tracking the very latest NFL story there. Quick snapshot on what's going on in markets. There is a hesitancy in these markets. We're trying to understand the calibration, the significance of the response from Israel on Iran. But really, these equity markets are just that little bit hesitant. S&P 500 down by a third of 1%. You've got to consider, as we go to the jobless claims today, it's going to really have hesitancy between now and the non-farm payrolls tomorrow. Yields up ever so slightly, up 2 basis points. Coming up, we'll set you up for your trading day. We have got a little bit more economic data on this slate, along with, you got it, Fed Speak, right here on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It is Bloomberg Brief. I'm Menace Cranny in New York. Here's a look at what's on the slate today. Economic data around 8:30 a.m. Jobless claims, incredibly important post-ADP in advance of non-farm payrolls. Then you're going to get the S&P PMIs, 9:45. The services numbers come out at 10 a.m. So a lot of data to set you up for this bond market. Yields have spiked ever so slightly. Fed speak. Schmidt, Kashkari, and Bostic all on the slate. They start speaking at 10 a.m. Some stocks to watch. Levi Strauss. Remember those jeans? They sink. They've tempered their full-year sales forecast. The third quarter sales also trailed Wall Street expectations. And a little bit of a check on commodities for you. This is what we've got. Brent is, sorry, that's Levi Strauss, I should say, pre-market down 11.59%. On the oil market, this is what we've got. We're up 1.7%. There's a lot of action in the options market at the $100 level. You're looking at quite a lot of call options trading there. Brent is bid. We wait to understand the Israeli response to Iran.
guaranteed or even that it'll be easy, but at least there's a theory of change.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The Fed's laser focused on the labor market.
There's some slowing, but it's not contraction. It's not deterioration of the labor market.
These are still numbers that are very constructive for the labor market right now.
Everything's on the table for this Fed. You could get to 25s if the jobs data are good.
The distribution of risks with respect to the labor market are clearly skewed to the downside still, even after this 50 basis point move.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, well off all-time highs. This equity market rally is firmly on pause. And that move continues this morning. We're pulling back by 1/3 on the S&P 500. We're down 0.4 on the NASDAQ 100. We're down by 0.6 on a Russell. Your 24 hours look like this. The next 24 hours critical for the labor market. 8:30 Eastern time, we've got jobless claims. Then it's all about tomorrow, Bramo. Payrolls Friday, just around the corner.
It's hard to make too much necessarily of the pause, and yet it is notable given the fact that we've just had the biggest three-quarter gain going back to 1997 for the S&P 500. How much is hinged on this idea of a Goldilocks cooling but not cold when it comes to the labor market? In other words, how potentially surprised could this market be if growth scares are no longer in the fore, but maybe the idea that the Fed isn't going to deliver on the same kind of rate cuts that many people were expecting?
The rest of the world seemingly leaning towards an easing stance. We've got a bit of news for you from both the UK and from Europe. This from Governor Bailey speaking to the British press. Could become a little bit more activist when it comes to rate cuts. Isabel Schnabel, executive board member over at the ECB. We cannot ignore the headwinds to growth. It looks like maybe the ECB and the Bank of England are preparing to play catch-up here.
The Bank of England saying that as long as inflation data remains good, they can keep on cutting rates more aggressively. Isabel Schnabel was the hawk on the committee, the person who wanted to say, look, inflation's still a concern. For her to come out and basically pave the way with a gilded rate cut, certainly this month, if not going again, raises the question, is the ECB going to be so far behind the Federal Reserve by the end of this year when it comes to how many rate cuts they've implemented?
The euro a touch weaker, the pound a whole lot weaker. We'll pick up on the sterling story a little bit later this hour. Need to pick up on crude as well. 3-day rally on WTI and Brent. The scores look like this. AMH 75 on Brent, WTI just short of 72.
The market is really just waiting for Israel's response. And when you look at this Axios report, they say officials in Israel say there's going to be significant retaliation and it could target oil production facilities. Halima Croft put out a note yesterday talking about, well, where are Iranian oil facilities? How much are they producing? They're exporting right now about 1.7 million barrels a day. So that is really the concern right now in the oil market, even though we talk about the fact that there is a lot of supply, there's spare capacity, and China's demand isn't quite up to speed. This geopolitical concern, the fact that there could be escalation, is starting to add a little bit more of that risk.
Some people are saying, what took them so long? It seems like this has been percolating for quite a while. Why haven't we gotten more of this kind of response in the oil market? What I find interesting, putting aside the potential escalation and the oil market dynamics, is how this has affected the bond market. The fact that suddenly this has reintroduced this question of, are bonds going to act like a haven asset in the case of some sort of oil disruption, given the fact that could raise the specter of noisy inflationary pressures, at least in the short term?
Always highly dependent on what the central risk is. If the central risk is higher crude prices and higher inflation, you've got a very different story in the bond market. I think what we need to get our hands around this morning, and we'll speak to Citi a little bit later on, how many barrels are actually at risk here? If you go after energy infrastructure in Iran, we're not just talking about Iran. Aren't we talking about compromising the whole Strait of Hormuz as well?
Well, yes, and not only that, what does this mean in terms of the Iranian retaliation? Will they go after regional players? Will they go after potentially oil facilities and some U.S. allies in the region? That is why there's a concern. Does this become a tit for tat within the energy space?
Brent crude right now, 75. 21. Coming up this hour, this is what your lineup looks like. We'll catch up with Matt Miskin of John Hancock ahead of fresh labour market data this morning. Stephen Cook of CFR on Israel's next move. And Jordan Rochester back in the sea over at Mizuho. We'll speak to him as yen weakness makes a big comeback. We begin this hour with global equities heading for their first weekly loss in 4. Investors are waiting jobless claims at 8:30 Eastern ahead of payrolls tomorrow. Matt Miskin of John Hancock writing the US City Economic Surprise Index improving likely means we step back from 50 basis point rate cuts to the next Fed meeting. Powell hinted at this in his recent speech. Matt Miskin, I'm pleased to say, joins us now for more. Matt, this market rally is broadening. Do you think the data and the earnings that are still to come will validate this move?
We actually don't believe that this data is going to be that strong. I think that the Fed is going to have to go back from saying 50 basis points. I mean, Powell has communicated this. He's done a really good job at it, actually. He was like, don't expect 50 basis points per meeting. And then this week, he's like, look, it's going to be more likely 25. That's what we put in the summary of economic projections. And as Lisa has been saying, the data is getting better. So he's likely going to have to pull back on the dovish tone. To us, that's going to mean the market's not going to be as happy about this. And we're probably going to continue to see chop. The last time in 1997, we had 3 great quarters like this. October was a tough month. So we actually expect some volatility here near term. We think there's going to be some stuff to look at in the bond market in particular, to look at as opportunities. But near term, some volatility may be in store here.
Matt, just to be super, super clear, going into payrolls tomorrow morning, are you saying good news might not be good news?
Unfortunately, we're back in the future, or back to wherever that was. It's a phase where good news is bad news, but I think that the bond market had priced in so many cuts, and the near term, it was overly optimistic on the cut scenario. I think actually yields could come up a little bit. It'll be a buying opportunity for long-term investors. We would look at it as an opportunity. But you also have other things. You have the geopolitical risk. You have the port strikes. You have all these inflationary pressures. And it's too soon for the Fed to go back to saying, hey, this could be transitory. Too soon. Too soon. You can't be like, they already got burnt on transitory before. You can't say, well, we've got all these inflationary pressures near term. We're just going to overlook them. I think they have to actually be a little hawkish here in the short term.
Other people who share your view, Matt, I'm thinking of Ed Yardeni, for example. I'm thinking of Torsten Slok, also see equity outperformance. They also see that this positivity, this better than expected economic data will support riskier assets at the behest of bonds that might actually struggle or be range bound. Your view is actually kind of the opposite, the idea that it is time to go into bonds and be much more cautious when it comes to risk assets. Can you explain how you come to that conclusion?
Well, a lot of good news is priced in. I mean, the valuations here, you're looking at 21 plus times. On a trailing basis on the S&P 500, we're at 26 plus PE ratio. Typically, after 26, you go to 27, there's never been a 10-year return that was actually positive from that level. We're already at peak valuations. Broadening of the market, I didn't think broadening of the market was going to be Chinese equities going up like a hockey stick, but that's where we are. And it's a bit of that hot money. You know, we're seeing these signs where it's hot money is running around. Maybe it's YOLO capital. But at the end of the day, this hot money is not actually a sign or a symptom of healthy kind of market behavior. And if you get some geopolitical risk, you get some inflationary pressures, you get some hawkish Fed, I actually think that means short term, some corrective price action.
I look forward to the movie Hot Money Running Around. I am wondering, though, about the idea of China. You're talking about how that's the broadening out that people weren't expecting. There are a couple of leading economists in the region who are expecting some $1.4 trillion of additional fiscal stimulus, given the needs and given the reception to the bazooka that has been unleashed so far. At what point is this no longer hot money? At what point can you look at some of the fiscal stimulus and say, this isn't just tourism, but something fundamentally that has changed?
It comes back to earnings, Lisa. And at the end of the day, earnings in Chinese equities are where they were in 2011. So it's been over a decade and earnings growth has gone nowhere. The multiples in the Chinese equity market has really risen as of late. It's all been multiple expansion. But at the end of the day, that's why the S&P 500 and U.S. equities have been the dominant equity market, is because the earnings growth are the best in the world. It doesn't matter if you're a small cap stock, a value stock, a Chinese stock. It doesn't matter where you are. At the end of the day, earnings growth is what drives equities. Stocks follow profits. It's really simple for us. That's what we talk to our clients about. But at the end of the day, Chinese equities need to break out on an earnings basis, and they're still caught really where they are for the last decade. And until we see that, we frankly think that this is more of a value trap than in hot money chasing kind of stimulus headlines than a fundamental change in the market.
Matt, can we go back to the jobs picture? Right now, the United States basically has two domestic issues that is going to affect the job market, the hurricanes and also what's going on with the dock workers. I'm more interested about the November 1st report that's going to look back on October. What are you expecting?
Yeah, a lot of noise. Yeah, great point. I mean, as if the Bureau of Labor Statistics jobs report was this kind of quality data point. I mean, the revisions have been massive overall. You've had to go back over a year and rechange a lot of the data. Every month is revised. And then you've got all these different, maybe it's one-off events or kind of, shorter term events that are probably going to really cause a lot of data issues. And it makes it's almost like, you got a blindfold on as it relates to the Fed, because then you're trying to make policy based on the employment data, which is the most important thing they're looking at right now. But the ADP report was a bit better. Initial jobs claims have been low. I think you have to bake in that there's going to be some lower quality elements to the data in the next couple months. And it's a tough time to really be, hey, we're going to take this with a grain of salt. We can't really be super confident in the data because it's a pivotal time for the Fed to really stick the soft landing. If they really want to do that, we think they got to cut aggressively. And the data is not going to be very easy for them to follow.
So does bad news on November 1st potentially mean another 50 basis point cut?
I think so. Yeah, I think if the jobs data does diminish, I don't think they can give that, excuses to say, hey, well, there's this and that and the other thing. I think they have to go ahead with the 50 basis point cut. But I mean, we're going to have a lot of data across the board. The quit rate in the JOLTS report is dropping off a cliff. You could see, the Conference Board's consumer survey, you could see basically jobs hard to get, keeps getting harder and harder to find. So it's all in the mosaic of the jobs data. But if you got a couple bad reports, I don't think they have the ability to kind of brush that off. I think they're going to have to cut.
Hey, Matt, appreciate it. Matt Miskin there. John Hancock going into payrolls tomorrow morning at 8:30 Eastern time. I think a lot of people have come on this program in the last few days and put even more weight on the October report and even less weight on the September report that we get tomorrow morning, primarily because there's going to be a lot of disruption in the next month. And it's going to be very interesting to see whether this Federal Reserve comes out ahead of time and sets up this market to look through what could be some real weakness.
And which way do they look through it? In other words, do they err on the side of cutting much more aggressively, or do they err on the side of being more tepid, of going 25? And that also will tell people where the bigger concern is and where they're putting sort of their thumb on the scale when it comes to the size and speed of the rate cuts.
The median estimate in our survey, 150K. The previous number, 142. Futures a little bit softer this morning with an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The European Union reportedly has enough support to impose definitive tariffs as high as 45% on imported electric vehicles made in China. According to Reuters, France, Greece, Italy, and Poland will vote in favor of the tariffs, likely giving the EU enough support to pass the vote. The support comes despite the risk of potential retaliation from Beijing. The EU's 27 member states are expected to vote on the measure tomorrow. Staying on EVs, Toyota is pushing back plans to start making its first U.S.-made electric vehicle. The Japanese car maker initially targeted late next year to begin production on the EV, but a company spokesman says that has slipped by a few months into 2026. This coming as demand for battery-powered vehicles has slowed. Still, Toyota says it's committed to making a battery-powered SUV at a factory in Georgetown, Kentucky, and says it plans to sell as many as 7 EVs in the U.S. within the next 2 years. And it's time for China to unleash a fiscal bazooka. That's according to Jia Kang, a leading economist in China. Kang says the country has room to ramp up fiscal support for the economy by issuing as much as $1.4 trillion in special debt, underscoring growing expectations for Beijing to expand public spending as part of its stimulus package. The Economist thinks the issuance could lift confidence by drastically raising government investment in public projects. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Woke up in shock, looked at the Hang Seng, and it was an odd colour. The colour red. Hang Seng Enterprise Index snapping a 13-day rally in today's session. Over that period, we're talking about gains of more than 30%, 3-0 over that period.
How many notes have you read saying we're tourists? We're not necessarily committed. We're not exactly settling into Chinese
Trade,
equities.
not an investment.
Exactly, and that's basically what you felt. People saw the 30%. They said, ka-ching, we'll hold that, and then we'll wait to see what else is next.
The Hang Seng down today by 1.5%. Up next on the programme, a man-made disaster.
This natural disaster is incredibly consequential. The last thing we need on top of that is a man-made disaster. What's going on at the ports? We're getting pushback already, and we're hearing from the folks regionally that they're having trouble getting product they need because of the port strike.
The latest on the strikes up next on the programme, live from New York City this morning. Good morning.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This rally stalled. We're down about 0.4% on the S&P 500. There's a growing sense, though, that once we get over these near-term hurdles, this rally can carry on. Goldman Sachs, Scott Rubner. I'm bullish on U.S. equities for a year-end rally starting month-end. I'm worried that my 6K target is too low. In the bond market, yields high by 2 basis points. The 10-year 380.56. Under surveillance this morning, a man-made disaster.
This natural disaster is incredibly consequential. The last thing we need on top of that is a man-made disaster. What's going on at the ports? We're getting pushback already, and we're hearing from the folks regionally that they're having trouble getting product they need because of the port strike. The owners are making tens of millions of dollars from this. The last thing they need is to profit off of this. It's time for them to sit at the table and get this strike done.
So here's the latest. President Biden upping pressure for port employers and shipping lines to reach a deal, as every major container port on the Atlantic and Gulf Coast remains shuttered. He joins Vice President Kamala Harris in blaming the shipping companies for the disaster, with the election just around the corner. Bloomberg's Katie Lyons joins us now for more. So, Katie, let's start here. How far apart are these two sides?
Well, on wages, John, according to the Transportation Secretary, Pete Buttigieg, they're not that far apart. Of course, before this strike actually began on Monday, the U.S. Maritime Alliance put an offer to the union that they would raise wages by 50%. What the union is actually looking for is a 77% raise over the 6 years of the contract. They want the starting rate to be $5 above what the final year six term was in the contract that just expired. That would be $44, and they want it to go up $5 for each year, ultimately culminating at $69 an hour by the final year. And what the union leader wants is that wage agreement to be a precondition for a return to the bargaining table. The two sides aren't talking right now. It's unclear when exactly they're going to be back at the table once again to discuss what the other issues are that the union would like to see resolved, which of course deal with things like automation or even semi-automation at these ports. That is potentially a thornier issue. Wages is one thing, but the other parts of this negotiation that wages, the union says, would unlock could be a lot more difficult, and there could be further distance between the two sides on those issues.
Katie, that's a pretty substantial wage increase, especially when you look at what they're making right now. With overtime, most of these individuals are making over $100,000 a year, and some even north of $200,000 a year, according to reports, when you lock in overtime. So does the issue really come down to automation and that language in this contract?
Yeah, the union says they want ironclad guarantees around automation, and that language is incredibly important. But again, to get to the actual nuanced argument around what the language of a contract will be, the union is saying you have to meet those wage demands first. And what they say about that, those higher end earners of these dock workers is that they have to work incredibly long, difficult hours in order to actually make that kind of money. So they want that factored in to consideration here. All that said, as you talk, Anne-Marie, of this notion of that this is pretty sizable increases, what they would point to, what President Biden is pointing to, is he still is on the side of the union here when he's talking about a man-made disaster. He's really putting the blame at the foot of the men and women who control these shipping companies. He says their profits went up 800% during the pandemic, and that workers deserve a fair share of those profits. So he wants to see collective bargaining as the mechanism for making that fair wage increase happen, which is why this White House is still maintaining they will not be invoking Taft-Hartley to stop this strike, even as we get closer and closer to Election Day.
And another salvo for those companies. President Biden yesterday saying that he directed his team to monitor any, quote, price gouging that he thinks these carriers could be going after. So Joe Biden has come out and always said he's Union Joe. Tim Walz at the debate yesterday said, hey, I'm a union guy. How is Kamala Harris talking to the unions?
Well, she has been really trying to align herself with this administration she's been in for the last 3.5 years, describing them as a pro-union administration. She has made it very clear that she would not be changing the tune of President Biden when it comes to being on the side of organized labor. And we're actually seeing her today traveling to states in which organized labor is incredibly important. She'll be spending most of the day today in Wisconsin, then traveling to Michigan. These are these blue wall, Rust Belt states in which blue-collar workers and union workers are incredibly important as she tries to secure them in order to win the Electoral College. So this is a very tricky line for her to dance here. She does want to be pro-union, but potentially when the effects of this strike really could be felt, which broadly economists think won't be for several weeks, as a lot of companies brought in supply in anticipation of this potential strike in advance. It'll be a while before shortages are really visible to the American people. That obviously could create a problem as that brings us closer to the election day, but she also doesn't want to alienate the labor vote.
Kayleigh, Biden talked about this as a man-made disaster. It was in contrast with something that was not man-made in any way, shape, or form, and that is the devastation that you're seeing in southern states as a result of Hurricane Helene. There has been a focus on getting federal funding to cover almost all of the spending. Some estimate that the cost of the storm could be $160 billion. Just even the agricultural losses could be $7 billion alone. How difficult is it to get the federal government to release this funding in short term at a point where this is just contentious, the idea of spending and where this is going to come from?
Well, the emergency money can come a lot quicker given existing authorities. So where the emergency declarations, disaster declarations have been made, that money is already flowing. I actually spoke with Pete Buttigieg, the transportation secretary, earlier this week, who said looking at infrastructure that has been damaged, the transportation department does have money ready, sitting and waiting to be deployed once the actual just cleanup is over and they actually start looking at repair and recovery. That said, this White House has made it clear they could potentially need to put in a supplemental funding request for Congress, because you're absolutely right, Lisa. When visiting the disaster areas yesterday, Harris in Georgia, Biden in North Carolina, each of them respectively announced 100% federal cost share for what the recovery is going to cost. Once we know what that total dollar figure is when we'll know how much Congress is going to need to be involved here, with the reminder that Congress is not currently in session and not scheduled to be back until after the election. Now, members of the House, of the Senate from these states that were affected by this disaster have called for them to return to address this. It's just unclear at this time whether leadership is going to adhere to that and they'll come back to Washington.
There are 33 days left, I believe, maybe even less at this point, until the election. And there are a number of issues, whether it's the strikes at the docks, whether it's what's going down in the southern states, whether it's the potential for the Middle East conflict to potentially send oil prices higher, that could cause a real shift in the economic backdrop heading into the election. What's the level of concern among people who you speak to about that?
Well, it's October, Lisa, and there's always room for surprise. We got at least 3 of them just in the first few days of October here. So certainly that is a risk, especially when it comes to those factors that you're rightly pointing to could affect the economy. Democrats I speak with are very encouraged by the fact that Kamala Harris has been polling better on the economy, not just relative to Joe Biden, but relative to Donald Trump as well, with her in our latest Bloomberg Morning Consult swing state poll trailing him on the overall issue of the economy by just 4 points and actually leading him in some areas when it comes to things like housing and helping the middle class. The concern is that if we start to see a more material turn in the economy or inflation would spike again, people are faced with higher sticker prices at the grocery store, higher gas prices at the pump, that could then deteriorate sentiment. Obviously, a lot of economic feeling right now, maybe largely baked in with less than 5 weeks to go. But if there is a material change in that, as voters get ready to head to the booth on election day, it is seen that the incumbent administration, which includes Vice President Kamala Harris, could feel the most direct blame for that, and that could be something that is problematic. On the other hand, those foreign policy related issues that could lead to, say, a higher spike in oil prices, the fact that she has been in the Situation Room is something she and the White House have been playing up this week, trying to essentially make her look like someone who could be commander-in-chief. So while there could be some advantages, certainly disadvantage could come with it too.
Kelly Lyons, appreciate the update down in Washington, D.C. from the nation's capital on some of the difficulties facing this country right now. Coming up on the program, Stephen Cook of CFR on the military response. Israel is vowing against Iran. That conversation just around the corner. Equity futures on the S&P down 1/3 from New York. This is Bloomberg.
Because I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Jobless claims 8:30 Eastern Time, then 24 hours later, we'll get payrolls in America. Equity futures on the S&P 500 pulling back by 1/3%. The view from Bank of America, the risk is to the upside, absent a big miss. We think slight weakness may be overlooked by investors and only sizable misses reignite recession fears. We're pulling back nevertheless. We're down by 0.7% on a Russell 2000. If we switch up the board and get to the bond market story at the front end of the curve, the 2-year in the 360s, which is where we've closed all week so far. The low to mid 60s, 365.80, Lisa, on a 2-year, up a single basis point.
A number of different research pieces that I've been reading highlight how range-bound is sort of the new normal, because basically the upside and the downside is relatively balanced. That's what a lot of people are feeling. A lot of people expecting that probably we have seen the bulk of the rate cuts being priced in. Now the question really is just how good or bad is the economy? To your point, normally in September, we see a volatile negative month. We saw the best September returns going back to 2013 for the month. Basically, people snubbing their nose at this idea that it's seasonality.
Yields up by a couple of basis points as well on a 10-year, in and around 380.75. Let's turn to foreign exchange. This one stands out. 3 days of sterling weakness. Cable, 131.16. If we closed here right now, it'd be the biggest one-day loss going back to March 2023. Governor Bailey speaking to the Guardian newspaper. The quotes coming out of that suggesting he's ready to get a little bit more aggressive and inflation heads in this direction.
Because he said he's going to get a bit more aggressive if they end up with inflation staying where it is. Key question here is how much of this means that the Bank of England and the ECB, for that matter, will be actually on par with the Federal Reserve. Everyone was expecting the Fed to move much more aggressively, but is it really maybe the flip side, that it's going to be more on par and you might actually see a little bit more dollar strength after a pretty steady streak of dollar weakening?
This is the UK, particularly also for the ECB and the European economy. Europe is really struggling. We talked about Isabel Schnabel a few times already this morning, the executive board member of the European Central Bank, really highlighting weaker growth on the continent, which has been clear for the rest of us for quite a while, but hasn't come up on the ECB's Governing Council meter, according to the news conference we've been getting, in a big way.
What's shocking to me is that they were talking about weakening growth. We could all see it. We've all read about it. It's been visible in the data. But the inflation rate hasn't been that high, and now we saw it fall below that 2% level across the Euro region in places like Germany and places like Spain, and you have to wonder, what else do they need? If they're a single mandate central bank, they have that single mandate as well.
There's a big energy component in all of that, but certainly the trend is lower inflation across the continent, at least for now. Under surveillance this morning, our top story in this country, catastrophe modeling. The firm, KCC, estimated the destruction from Hurricane Helene will cost insurers $6.4 billion. President Biden and Vice President Kamala Harris touring parts of the Southeast and announcing steps to bolster recovery efforts, with the death toll rising to 166 across 6 states.
Devastating photos as the president was surveying the area yesterday. 2 main issues remain that are really top of mind for a lot of these governors. One's that safe drinking water. You can't have kids go back to school without safe drinking water, and also power. Still, more than 1 million people without power in a lot of these states. I caught up with someone from Governor Youngkin's office yesterday and talked about the fact that this major disaster declaration they received from the federal government was the first time for Virginia since Hurricane Irene in 2011, trying to put into context just how bad this is. And they were saying, look, it's communities of 200, 300 people being washed away. And they feel like actually, you know, that's why there hasn't been as much coverage of what is going on in these southeastern states.
Also communities across this country, particularly in places like North Carolina and Tennessee, that you wouldn't typically associate with scenes like this.
That's part of the reason why a lot of people weren't insured. You think about $6 billion of insurance costs, that's actually nothing, a pittance relative to the $160 billion of potential damage. You have to wonder, people living in some of these smaller towns saying, why should I take out flood insurance and spend an extra $6,000 a year for flood insurance? What's the likelihood? We're not on a coast, we're not in a hurricane zone. Why would we get flooded out? And yet that is what happened with the tides rising and with 3 feet of water dropping across the entirety of Tennessee, as we learned the other day.
Especially when insurance in this country right now is certainly more expensive than it has been over the last few years. Let's get to the drama over in Europe. The EU preparing to vote tomorrow on imposing tariffs as high as 45% on Chinese-made EVs. Reuters reporting the measure has enough support to pass, with France, Greece, Italy and Poland expected to vote in favor of it. Germany indicating it plans to abstain.
That's a U-turn from what the German Foreign Minister Annalena Baerbock said to me. She insinuated in my question that Germany was not for these tariffs, that I was wrong. So I asked her point blank, so are you on board? She said, yes, of course, obviously. But then she did go on to say, but again, the world is not black and white. We have to look at different car companies. If a car company is producing and doesn't get unfair subsidies, then obviously the tariff should be imposed differently. The issue is the German government and the German auto sector are miles apart when it comes to how they deal with China and dumping on the EU market.
So let's get into it. Is this because they don't think it's the right policy, or they're just scared of offending their Chinese counterparts? What's this about?
For the car companies, if you ask them, they are very clear about it. Some half of their sales are in China. Some significant proportion of their overall business comes from the world's second biggest economy. This is something they don't want to play around with, because their business model would fundamentally shift if China really put up the gates in terms of European automakers selling into that country.
We'll be covering this story tomorrow, no doubt. We'll be catching up with Bloomberg's Ollie Crook, I hope, out of Berlin on this story. Let's turn to Israel, striking Beirut after 8 of its soldiers were killed in southern Lebanon in battles against Hezbollah. The world awaiting Israel's response to Iran's missile attack, with President Biden urging Israel to hold off from attacking Iran's nuclear facilities. Bloomberg's Jemana Besechi joins us now out of the region in Dubai. Jemana, can you walk us through possible targets? There has been a bigger conversation, a broader conversation more recently about the prospect of targeting energy infrastructure. How realistic, how likely is that?
Well, it seems pretty clear at this point that a reprisal is coming. Some of the options on the table could be targeting military infrastructure, similar to what happened back in April when Israel went after specific air defense battery. That was a very targeted strike, but then it ended there. This time around, there's a feeling that the response will have to be more forceful, and it could take the route of even covert operations targeting specific IRGC commanders. But then the other option being discussed, as you mentioned, is targeting energy infrastructure. So just to give you some numbers here, Iran produces about 3.3 million barrels per day of oil. About half of that is consumed domestically. Now, if Israel wanted to inflict economic pain on Iran, but without causing a massive spike in the price of oil, one option is to target specific processing refineries, where there's one refinery on the Persian Gulf that accounts for about 50% of the gasoline that is consumed domestically within Iran. That would take out about 400 to 500,000 barrels per day. So the impact would be quite astute for Iran, but not necessarily when it comes to global oil supply. So something to bear in mind there. And that, of course, is one of the options being discussed. And then quite literally, the last option is the so-called nuclear option, where Israel would go after some of the nuclear sites around Iran. Operationally very difficult, would entail coordination with the U.S. And also it's unclear at this point whether Israel actually has the military capability to take out these nuclear facilities and limit their ability to function in a meaningful capacity. And add to that, U.S. President Joe Biden was asked about it yesterday, and he said while he supports Israel's right to respond, they would not support them attacking these nuclear sites. So it seems as though the other options will be more likely.
Quite literally, the nuclear option. Jumana, thank you. Jumana Bassetti out of Dubai on the latest there. Stephen Cook joins us now, Senior Fellow for Middle East and Africa Studies at the Council on Foreign Relations. Welcome back to the program, Stephen. We'd love your early indication, your thoughts on where you think this is going. If you have an idea of what retaliation actually looks like, Jumana went through a series of potential targets. How are you thinking about retaliation?
All of them. I think that the Israelis are not going to limit themselves one way or the other, and they're clearly not listening to the President of the United States. I think there's a menu of options for the Israelis that include economic sites, leadership sites, military sites, missile sites, up to and including the nuclear program. I don't think the Israelis can hope to destroy Iran's nuclear program, but they can make a big point by hitting parts of it. I would remind everybody that it is the only country that has ever engaged in non-proliferation by force is Israel, in both Iraq and Syria. So there is precedent for them to hit nuclear programs. I think that the fact that there were 181 ballistic missiles fired at Israel from Iran really puts us in a much, much different situation than we were last April. And the Israelis are going to make a very, very strong point. And so I think many of those sites that are under discussion may be hit, and they may be hit simultaneously.
Stephen, yesterday the president said that Israel has a right to respond, but they have to respond proportionately. Does Israel respond to the intent of destruction that Iran do, or do they respond to the destruction that Iran actually got to? Because in the end, they didn't really destroy much. All of this was struck down.
Yeah, I think that there was probably more damage than the Israeli censors are letting us know. But nevertheless, I think that regardless of what the President of the United States says, and I know that that's an extraordinary thing to say, it's been clear that the Israeli government hasn't really been listening to President Biden for quite some time. We're also in this interregnum 5 weeks before a presidential election. So I think that whatever the president, whatever people are saying in Washington about proportionality, the Israelis are going to choose their targets as they see fit in line with the point that they want to make and the damage they want to do to Iran's ability to threaten Israel's security. So that puts Iran's missile forces, military bases, IRGC headquarters, energy infrastructure, and like I said, even possibly the nuclear program in Israel's crosshairs.
You mentioned the election, so I just want to get your take on what Secretary of State Antony Blinken wrote this week in Foreign Affairs. Quote, the Biden administration's strategy has put the U.S. in a much stronger geopolitical position today than it was 4 years ago. Is he correct?
Well, it's hard really to make that case, particularly in the region which I focus on. That's not to suggest that the instability in the region is directly related to the Biden administration's policies. I think the self-deterrence that the United States has been engaged in throughout the Biden administration is something that the Trump administration also engaged in, and something the Obama administration before it engaged in. I think this has been a bipartisan affair in which the United States has looked at the malign activities and chaos that Iran has caused throughout the Middle East and decided to respond in kind of minimalist ways, calling for de-escalation, not willing to take on Iran directly. Now, I'm not saying that that we should have gone into Iran and engaged in regime change, but through all of these years, the Iranians have thus been able to build up Hezbollah, build up the Houthis, to the point that the Houthis now have leverage over shipping in the Red Sea. That's a very serious geopolitical problem for the United States and its partners around the world. So I would say, in all due respect to Secretary Blinken, when it comes to the Middle East, certainly the United States is not in a more advantageous geopolitical position.
Given everything that you just mentioned, what does a broadening out in this conflict look like? I've been struck by the fact that we haven't heard much from Saudi Arabia, from Jordan, from Egypt, even from the non-Hezbollah government from Lebanon. A question of which other countries will get involved, who will align with Iran, given that Russia is otherwise occupied, and who's going to align to counter Iran?
Well, it's clear that our partners in the Gulf are not unhappy with the damage that Israel has done to Hezbollah. I think all of these governments would agree that the Middle East would be better off without Hezbollah and without Hamas. I think they've been frustrated by how long and the methods in which the Israelis have used, particularly with regard to Hamas. But nevertheless, they're not unhappy about this development. The question is whether they will get directly involved. To some extent, they have been by their integration into CENTCOM, providing technical data to the United States that is then passed on to Israel when it comes to these types of ballistic missile attacks that the Iranians have engaged in both April and most recently a few days ago. But the Saudis and the Emiratis and others have signaled that they do not want to be in the middle of an Israel-Iran war. Now, geographically, they are, but Dubai is quite vulnerable to Iran's missile strikes. So is Riyadh. And as a result, the Emiratis and the Saudis have been positioning themselves as a conduit between the Iranians and the United States, and by association, Israel in this whole episode. I think that this is essentially a conflict between Israel and Iran, and Israel can expect support from the United States, technical support from Arab governments, but not high-profile support. And there might be some support forthcoming to Israel and the United States from European powers like Great Britain and France.
Stephen, one just quick final question, and forgive me, it could be the title of an essay, so we don't have that much time.
Maybe
Can you tell me why it's been so difficult for America to establish deterrence in the region, why that's been so elusive over the last year?
It's our hangover from Iraq. We went into Iraq without, let's just put it this way, it was a strategic blunder. And now foreign policy policymakers have been quite careful about the use of force, even when, unlike Iraq, the use of force is warranted.
Stephen Cook, thank you, sir. Appreciate it. Stephen Cook of CFR. We'll catch up with you soon, no doubt. If you are just tuning in, welcome to the program. Equity is just a little bit softer off the back of that conversation on the Middle East. Crude is higher for a third consecutive day. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Warren Buffett is still selling Bank of America stock, but not as much as before. Buffett sold $338 million worth of shares this week, a sharp drop from earlier rounds where he sold about $750 million worth of stock per sale. Buffett hasn't said why he's cutting back on Berkshire's massive stake in the bank, but even then, the conglomerate still ranks as the top Bank of America shareholder. Meanwhile, SoftBank founder Masayoshi Son is outlining an aggressive timeline for the adoption of AI. Son claims the technology will be able to run entire households in only a few years' time. According to him, AI will soon be able to do things like monitor the health of family members, do the grocery shopping, make reservations, and much more. Son, of course, is known for making bold calls that have led to big wins, but big losses as well. And Eli Lilly's blockbuster weight loss and diabetes drugs are officially back in stock in the U.S. The Food and Drug Administration announcing the shortage of Lilly Zepbound and Mounjaro is over. The agency also warning knockoff drug makers that there are legal restrictions on making copies of FDA-approved drugs when there isn't a shortage. That's a blow to compounding pharmacies that have been able to capitalize on the limited supply of the medications. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, yen weakness back in the spotlight.
I think that the moves from the Japanese currency were very much based on questions over policy continuity in Japan under the new Japanese administration and the administration's direction towards monetary policy.
The worst day for the Japanese yen in more than 2 years. That conversation up next with Jordan Rochester of Mizuho.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest, and whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
David Weston,
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York, welcome to the program. Stocks pulling back by 1/3 of 1% on the S&P 500. Yields up 2 or 3 basis points on a 10-year, 380.75. Under surveillance this morning, yen weakness back in the spotlight.
I think that the moves from the Japanese currency were very much based on questions over policy continuity in Japan under the new Japanese administration and the administration's direction towards monetary policy. Any kind of market volatility for the Japanese yen is likely to die down in the coming months.
So here's the latest this morning. The Japanese yen coming off its worst day in more than 2 years as Japan's Prime Minister suggests the economy isn't ready for more rate hikes. Jordan Rochester of Mizuho looking for more of the same. Long yen is a very consensus trade. That may need to be unwound with higher oil and less Fed cuts priced. 148 is possible later this month if oil remains bid and NFP comes in line or better. Joining us now is Jordan Rochester. Jordan, welcome and congratulations for a new seat, for a newborn baby, and for Aston Villa. I noticed the tie, and not necessarily in that order. Let's talk about this, Jordan. Dollar yen. Tell me if we need the endorsement of the Japanese Prime Minister for the BOJ to make another move.
You don't need the endorsement, but it would help. There's been a lot of changes on the political front, new prime minister and new policies. So there's some pushback on this rate hiking cycle from Ashiba yesterday. Combine that with the dollar yen move, John, because you saw such a huge move lower in dollar yen over the summer that it actually could knock off quite a lot from Japanese inflation from the goods sector. A simple chart of just FX moves versus headline inflation of goods, that's 1% off the headline rate of CPI from the FX move alone. And this is a tepid recovery in the Japanese inflation story. I think structurally the domestic data suggests that the BOJ should be hiking. However, the politics with an election coming up and those moves in FX mean the near-term October-December meetings quite unlikely we get that rate hike. January is still possible, John, but you need a weaker yen to make it easier for the Bank of Japan when it comes to their inflation forecast to do so. And it gets a bit circular, because BOJ hikes equals a stronger yen. So that's why you see these big narrative shifts. I actually think there will be a lot more volatility in dollar yen as we go into year end.
Well, from a risk perspective for international markets, Jordan, how ring-fenced is this story in Japan?
It's definitely not ring-fenced. I mean, the wage story is what makes me confident that the BOJ should be on the same setting as they were, talking about a very gradual, every 6 months or so rate hiking cycle. We're just talking up to a terminal rate of 75 basis points to 1%. So it's not aggressive like you saw in the Fed or the Bank of England or elsewhere. But if you have domestic developments, so if you have a global recession, if you have yen strength, they don't actually need to hike because that will do a lot of the work for them. So it remains very much market dependent, market state dependent. If dollar yen was at 160, for example, it'd be very easy for them to go ahead with the rate hiking cycle, John.
That said, Jordan, just to build on what John was getting at, back on August 5th, there was this carry trade that a lot of people attributed to this incredible spike in volatility across asset classes because of how much leverage was built up in that. Has that been unwound, or has that been built right back up as people realize, all right, maybe we're back to square one here?
In the banking flows, you could suggest it hasn't been completely unwound. It takes a bit of time. But in the FX and sort of rates flows, it was not just unwound, it was taken the other way. So we went from a massive yen short, so it became very clear when you had that yen positive news in August with the rate hike, and you also had softer US data with NFP and the SARM rule being triggered. You had massive deleveraging of that carry trade in the FX space and in rates. And then it went through to massive yen longs. So that's kind of why we're seeing yen under pressure over the past couple of days, with the idea of the politics becoming a bit more harder for the Bank of Japan to do that rate hiking cycle.
When you look at positioning, one thing stands out, and that is the short position on the dollar. This expectation broadly, a consensus, that the dollar will weaken as the Federal Reserve cuts rates. We've seen a shift in that over the past couple of sessions, with the longest streak and the biggest streak of dollar strength going back to earlier this year. I wonder, Jordan, do you expect that to continue, given the fact that suddenly it is more feasible to see the ECB and the Bank of England act more aggressively?
I'll tell you what will continue, this mean reversion we've seen in the dollar and the sort of narratives in the market. And that's because the central bankers are so data dependent. You get 1 month's hot NFP or NFP print or 1 month's soft print. It changes the narrative from the Fed, and therefore you have dollar reverse everything it did over the previous month. So in answer to the question, I think that the dollar strength that we've seen is on the back of better, harder data. So initial jobless claims has been healthier in the past couple of weeks. I think the NFP will probably be in line at 4.2%, and then the dollar strength can continue in October. Then we get to next month's print, and then we'll have the impact of Hurricane Francine, the impact of the Boeing strikes, and who knows, we might have a soft NFP print, and it will feel like, for you guys who have to listen to people talk about this every day, very hot and cold, very flip-floppy. And I'm just a man from Birmingham trying to understand that I think the US data is better than Europe and the UK. And I think the European central banks have been way too hawkish compared to the Fed, who've been slightly too dovish, really. And that makes an easy trade for me, being looking for short euro and short sterling expressions versus the dollar.
Well, you're an outsider looking in. When you're in the United States and you see local reports based off the docs, people are starting to hoard toilet paper, you start to think a little bit differently about what's going on. So when you start looking through potentially this messy payrolls report in November, what does that mean for the dollar? Does that mean bad news, potentially good news, because it could mean the Fed cutting 50 basis points?
It could be bad news for the dollar if you get a sort of dovish response from the Fed from that unemployment report. What we've seen over the past few days is higher oil prices thanks to Israel, Iran. We've seen pretty healthy JOLTS figures out the US, and we've seen a repricing of the market for the next Fed meeting. The idea of 50 basis points has been reduced. We're getting close to something like unlikely in terms of market pricing now. It was quite the consensus just a few weeks ago. If we get to the next NFP print, it's one of those weird Fed meetings where they have the luxury of 2 NFP prints in a row. So if you have a good one tomorrow, and if you have a bad one next month, it will make it a 50-50 toss-up whether the Fed does that 50 basis points. The problem is it will come during the Fed's blackout period. We won't be able to hear much from them during that window. We'll have to listen out for Nicky Leaks at the Wall Street Journal.
Jordan, how good did last night feel? I'm just a man from Birmingham. I'm just a man with family from Birmingham. Jordan, how good did last night feel for Aston Villa?
I think the streets of Birmingham were electric last night. You heard it in the stadium. What a win, historical. Couldn't be more proud of the team. Hence, why the Villa tie's on, John.
There we are. Good to see you back in the seat, buddy. Welcome back. Jordan Rochester there of Mizuho. Coming up next on this program, Jared Woodard of Bank of America, Adam Posen at the Peterson Institute, Jonathan Gold of the National Retail Federation, and Neela Richardson of ADP, the second hour of Bloomberg Surveillance. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo Pet Products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The economy is pretty resilient. I think we still have some turbulence ahead.
We wouldn't say inflation risk is off the table completely, but it's certainly much lower risk than it had been.
If we were to see a much steeper slowdown than what we're anticipating, you certainly could get a steeper rate of cuts.
We don't really need that kind of stimulation, but it looks like we're going to get it anyway.
The fact that they are cutting is supportive of the risk sentiment, which is what we're leaning into.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with your equity market on the S&P 500 pulling back by 0.2%. The scores look like this on the Nasdaq, just a little bit softer as well. Likewise on the Russell. On the Nasdaq 100, we're down 0.25%. On the Russell, the small caps down by 0.6. The week ahead, the next 24 hours for the labor market, it's going to be quite pivotal potentially because nothing definitive so far this week. Tuesday, the data was somewhat soft. Wednesday, okay, looking at the ADP. Later on this morning, jobless claims at 8:30 Eastern Time, which has been in and around 220 now for the last few weeks.
We've been asking repeatedly this week, what is more disruptive to this market, an upside surprise or a downside surprise? Matt Miskin of John Hancock earlier this morning talking about how the Citigroup U.S. Economic Surprise Index has turned positive. It is actually the most positive right now, going back to April. It raises this question, could this be the source of angst in markets that maybe if the Fed starts getting maybe pushed to be a bit more hawkish or less dovish, does that disrupt some of the euphoria that we've been feeling over the past few weeks?
I think we're more inclined to call these guesstimates and not estimates when it comes to payrolls. It gets much, much harder to guess them in the next month or so. We've got the strike at Boeing. We've got strikes at the ports across the eastern Gulf Coast in this country. You've also got the election anxiety, which some economists believe is leading to some companies to hold back on hiring as well. So take a guess for the month of October. That early November report that we get, I think, on November 1, tremendously difficult to forecast.
Not only that, also the effects of the hurricanes. People don't have access to clean water. People don't have power. They're not going to work. And so what I think when you hear from everyone on Friday, whether or not it's a good or bad report, they're going to say, well, this one doesn't really matter because the next one is the one that matters a lot. And it might be so noisy and difficult. But how does the Fed communicate to that, to Jordan's point, when they're going to be in a blackout period?
Neil Dasser has made this point a few times over at Renmac. Ultimately, we're in the risk management business. If you no longer believe inflation is a big problem, if you're in the risk management business, cut interest rates. Just cut interest rates.
The problem is, and we keep talking about this, we've been talking about this from before Jackson Hole, after Jackson Hole, there's no clarity. We don't know what the destination is. We don't know what the neutral rate is. We don't know how far we are from it. We know Austin Goolsbee thinks that we're way, 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 way far away from it. And other people are saying, hold on, not so fast. You were speaking yesterday with Mark Rowan of Apollo, who said this is a very expensive rate cut. This is a very expensive insurance policy. So you start to put this all together, and is there the same sort of uncertainty on the Fed board that there is among market participants who are completely on opposite sides when it comes to this issue?
Mark Rowan, financing is available. Real estate prices are going up. It's not clear. We need more rate cuts. To the extent we accelerate the economy and have to go in the other direction, that would not be a good day. Adam Poson's joining us in just a moment, in about 15 minutes' time. He's still got a call for rate hikes in 2025.
I want to understand from his point of view whether he's seeing anything on the ground now that indicates that inflation is starting to rear up again, because we did see in the internals of, say, the ADP report, there still is disinflation when it comes to wages. We see some of the other CPI reports from around the world. Disinflation is much more prevalent. Or is this just an expectation of policy and how much it could shift things, and just how vulnerable this economy is to a reigniting of that inflationary push based on the lack of softness that he's seeing currently in the
Fueled
market?
by another rally in crude, potentially 3 days and up by close to 5%. The Middle East really igniting things over the last few days.
Absolutely, and now there's talk of potentially what Israel's going to hit. The President Biden has come out and he said he wants them to stay away from nuclear, but now everyone's talking about maybe it's going to be energy facilities, and then what kind of tit for tat would the Iranians then place on potentially U.S. allies in the region and their energy facilities? So even though we do have spare capacity, there's lots of supply in the market and demand in China is still very low, the fact of the matter is the market's starting to wake up that this conflict can get worse.
Brent crude 75.32. Coming up this hour, we'll catch up with Jared Woodard of Bank of America Securities on when to get bearish on bonds. Adam Poson of the Peterson Institute expecting the Fed to return to hiking next year. And Jonathan Gold of the National Retail Federation as he calls on Biden to end the port strike. We begin this hour with futures slipping as investors await U.S. jobless claims and tomorrow's payrolls report. Jared Woodard of Bank of America Securities writing, big upside for the classic deflationary trades of U.S. tech and treasuries requires big bearish economic data. Otherwise, the risk-reward for deflation trades is poor. Better to think about when to turn bearish on bonds for 2025. Jared joined us now. So, Jared, let's get straight into that trade. What you would substitute bonds for, and why you believe maybe some of the moves we're seeing in the commodity markets might be the beginning of something much bigger.
Yeah, thanks for having me. It's good to see you all. I think the big structural view from Bank of America Research Investment Committee is that the 2% world of the past 2 decades is likely giving way to the 5% world that was the norm for the 20th century. 5% was the average inflation rate across the G7 countries in the 20th century. And I think that level of normal that has been so unfamiliar for many of us for the past, couple decades is actually where we're headed over the next several cycles, maybe even sooner. The view from an asset allocation perspective is that bonds are going to be much less effective as a hedge for your equities. They're going to give you much lower real return. And you're going to be better off with higher equity exposure, higher commodity exposure, higher credit exposure, especially higher yielding parts of the credit market, than has been the winning trade for the past 20 years.
Do the latest moves out of China just increase your confidence around this thesis?
They do. I mean, we do think that the stimulus from China, while obviously helpful to the equity market in the near term, is not a game changer for the economic challenges that the country faces. China's government bond yield hit a record low of, I think, 2.0% in September. And it may be that the policymakers want to divert attention away from that part of the market and try to send capital elsewhere. But I think the important thing to think about is how different the world is from the past 20 years when it comes to China, when it comes to trade relations, to globalization, to even tech disruption, which is so deflationary the past 20 years, now is much more of a neutral factor. The software, the internet, smartphones, all pretty easy to adopt, easy to scale. Things like artificial intelligence and quantum computing are so resource intensive that even the tech disruptors, the big deflationary forces, come with a lot of front-loaded costs that we think present some pretty good investment opportunities.
Just to be very clear, Jared, how much are you saying that bonds just don't have a lot of upside, and potentially certain commodities, not necessarily even oil, but say lithium or gold or copper might be the real beneficiaries of just a new investment wave? I mean, in other words, how much is this saying that this is a new inflationary regime versus this is a different regime where bonds don't have the same characteristics as in the ZERP world?
Yeah, I think that the correlation between bonds and equities has been positive for most of U.S. economic history. If you look at that long-term data, you see that on average, they've moved together more often than they moved apart. to see really strong negative correlations between bonds and equities, you really just have to look at the last 20 years. And so, if, again, we think that structurally inflation is likely to be higher in the medium term, even in the near term, then those bonds are going to be much less helpful as diversifiers. Where do you go with your capital instead is always the next question. And we think there's good parts of the equity market where people can allocate away from big indexes. But within commodities, there's great places to be as well: gold, uranium, and tactically, like in present moments, oil.
Jared, I do wonder what this means for people who are putting money in money markets. There have been a lot of investors who come on this show and say, it is time to lock in these yields. It is time to get out of cash. Those people with $6.4 trillion of cash in money markets are losing out, fear of missing out. How much are you saying that's not true? And actually, they stand to benefit quite considerably because this is sort of the new normal. Cash is actually an allocation.
That's exactly right. I think that the optionality of cash for allocating, into trades as they come along is much higher now than it's been in a long time as well. When you can get paid a meaningful yield, even and possibly, a positive real yield on your cash, and preserve the ability to take advantage of opportunities in the market when they come along, that's a great place to be in as an investor. And it's not something that's been available to investors for decades. Data shows, by the way, that when the Fed starts cutting, even if you have investors with really high cash levels, historically, they haven't been prone to allocate away from those cash and cash equivalents until 9 or 12 months after cutting cycles begin. That's one reason why we don't expect some tidal wave of cash to come into the equity market, in the absence of some other economic catalyst.
Jared, you said present moment you'd be bullish on oil. Is there a ceiling for how high these prices can go?
Our commodity team has done a lot of great work on mapping out scenarios if, unfortunately, you had, further disruption, turmoil in the Middle East. They'll cite $100 a barrel and even higher, I think. The thought for us is that on a tactical basis, we do have ETFs that cover these, and we think it's an interesting moment from a tactical trade opportunity because positioning is so short. I think the CFTC futures data shows you that on some measures, you've never seen such extreme short positioning in oil. And if you think there is the risk of further escalation in a way that could be disruptive, or on a medium term, if you think there's a chance of a resurgence in inflation possibly next year, this looks like it might be an interesting entry point.
Just short of 72 on WTI this morning. Jared, we've got to leave it there. It's good to catch up, sir. As always, Jared Woodard there of Bank of America Securities on the commodity market and what you should be doing with your bond positioning. Just a note, just a programming note, just quickly. Bill Dudley, former New York Fed president, new column out on Bloomberg Opinion. I've been too pessimistic about the risks of a so-called hard landing for the U.S. economy over the past few years. We'll be catching up with Bill a little bit later this morning at 8:45 Eastern time, so look out for that. Let's take a minute to get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Israel launched a strike in Beirut overnight after 8 of its soldiers were killed in southern Lebanon in battles against Hezbollah. According to local officials, 6 people died in the Israeli strike on a building affiliated with Hezbollah in the center of the Lebanese capital. The Israeli government has not yet retaliated for Iran's barrage of missiles on Tuesday night. Meanwhile, New York Mayor Eric Adams may be charged with additional counts in his corruption case. Prosecutors said it is quite likely that other defendants will be named in relation to the additional charges. Adams' lawyer has urged the federal judge to dismiss the case, calling it, quote, flawed, as the mayor deals with growing pressure to resign. And Costco has expanded its lineup of precious metals. The wholesaler has launched the sale of platinum coins and 1-ounce platinum bars on its website for the price of $1,089.99. The deal is only available to buyers with a Costco membership, of course. If you want one, you'll have to move fast. Costco's platinum offerings sell out almost immediately. That's your Bloomberg Brief. John?
Yahara, thank you. Isn't that incredible?
Well, I just love it because it's really catering to all the doomsdayers. They can stock up guns, gold bars, and MRSA packages to just make sure that they're okay.
It's working. Gold year to date up by more than 28%. It's a trade that's working out.
You think about how people say always in China that's what they're putting their money into because they don't know where else to go. I wonder how much that's true in the U.S. as well.
It's truer. Can we say that? Does that make sense?
Yeah,
See
maybe.
more of it. Let's put it that way. Up next on the program, the risk of reinflation.
That's really the biggest concern right now is, are we going to overstimulate
because in the no landing camp, we're arguing we don't really need that kind of stimulation, but so it looks like we're going to get it anyway.
The latest on this conversation up next with Adam Posen of the Peterson Institute, who thinks you should be preparing for rate hikes in 2025 and not rate cuts. That conversation up next.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Just a bit of economic data to work through this morning. It starts with jobless claims at 8:30, then ISM services later after that, then tomorrow morning, the payrolls report, the estimate 150K, the previous number about 142. Into that, equities, negative by 0.25% on the S&P 500. Bond yields a bit higher by 2 or 3 basis points, 380.75 on a 10-year. Under surveillance this morning, the risk of reinflation.
I am in the sticky inflation camp that the long-run inflation rate is probably closer to a 3 handle, if not a 3 handle, then down at 2.0%, where the Fed thinks it's going to be. That's really the biggest concern right now, is are we going to overstimulate? Because in the no landing camp, we're arguing we don't really need that kind of stimulation, but so it looks like we're going to get it anyway.
So here's the latest. Fresh economic data and Fed speak very much on deck. Schmidt, Kashkari and Bostic speaking this morning after jobless claims at 8:30. Adam Posen of the Peterson Institute with this to say: I stand by my call that the Fed will stop cutting rates by March of 25 and will be hiking by June of 25, seeing a 40% chance if Harris is elected, 85% plus if Trump is elected. Adam joins us now. Adam, welcome back to the program, sir. We've got a lot to work through here. Let's just start at the top. Why is the outlook for you in 2025 so election dependent?
Thanks for having me back, John. I think it's election dependent in 2 reasons. The first is whether it's Harris or Trump, I think the commentariat and a lot of the market people are overestimating the likelihood that a divided Congress will prevent fiscal expansion. You will get some fiscal expansion if it's Harris, and you will get outrageous fiscal expansion if it's Trump. And Anne-Marie and I have talked about this on a previous appearance. I think Congress is not going to block it either way. The second reason is specifically to do with Trump. In a recent analysis the Peterson Institute put out last week, we go through very carefully what his plans for general across-the-board tariffs, particularly migration, deportation policy, and interference with Fed independence would mean. And that puts you at an inflation rate of well above 4% easily.
And you've made the argument also that you think the Fed should be preparing for two-way risk and should be preparing market participants and the general public for two-way risk as well. That reminded me, like it reminded you, of the situation that Governor Carney was in back in 2016. Why do you believe that's the right idea?
I think, John, thanks for having me back to talk about this. And you're right about the parallel with the Bank of England facing the Brexit call, something very political where they don't want to come down politically, but it's disingenuous to just sit there and say, well, what'll happen is what'll happen. I mean, in the end, that is what will happen. The Fed doesn't affect the politics or the outcomes. But if you're choosing to just every meeting just tack back and forth and update people's expectations, you leave a lot of room for volatility, and arguably you're going to cause more harm to the economy. Sometimes you have to be honest and just say, look, we are not going to pretend we, the Fed, have a view on Trump versus Harris, but we think there's a high risk of fiscal expansion and a high risk of additional tariffs and a high risk of disruption to labor markets either way. And all of that is inflationary or stagflationary. So therefore, we should not be encouraging the idea that there's either a further path of rate cuts in 2025 or encouraging the idea that all the risks are to the downside. This is different than the clip you just showed of Bianco. My concerns are about the policy changes and also, as I've written about and we've talked about, that the Fed is not as tight now as they think they are. It's not about that there's this persistent inflation, no landing. It's that new shocks are coming and policy is not as tight as they think.
There are two things here, Adam. One is they're not as tight as they think they are, a question around neutral, which is something that a lot of people in markets debate. Another thing is how much the Fed should try to get ahead of possible policy changes that could expand the deficit. How much would the Fed be exposing itself to incredible political risk if it weighed in? I mean, if it didn't ping pong around what the data is actually showing right now and tried to make a statement on whose programs would potentially be more inflationary at a time where the arguments on both sides contradict some of what you've been talking about.
Well, the arguments claimed, Lisa, may contradict, but the facts don't. And the Fed's job is to follow the facts and the basic economics. I think it is a risk either way. And obviously, Chair Powell and the leadership of the Fed has decided the way they're going to manage the risk is they're only going to talk about the next 3 months. And they're just going to focus on that. And that was very clear from the chair's speech at Jackson Hole. And so my push has been, at a minimum, admit that that's all you're doing and don't let people get notions about 2025 and beyond. But the second point is we're seeing a major erosion of politics and norms and stability in the U.S. And if you look around the world where there are countries where you have that, generally the central bank ends up having to be more outspoken, more principled, and more courageous. This is like in South Africa. This is like in India. This is like it used to be in Italy before the euro, that the central bank has to stand up. And the Fed's situation isn't quite as delicate, Lisa, as I think they think it is, and you just said it could be portrayed, because both Harris and Trump are going to lead to expansions of fiscal policy. Both Harris and Trump are not going to roll back tariffs and are going to increase them somewhat. The Fed doesn't have to say what we in a nonpartisan place can say. They don't have to say Trump is worse than Harris. They can just say the risks to inflationary policy are higher from both.
Adam, what would you say about the fact that even though people keep talking about the deficit, the bond market hasn't woken up to it, and a lot of people think it's never going to, simply because it hasn't in the past?
It's a fair concern. I mean, I don't have anything great to say about that, because this is the dynamic you get. The U.S. is the global reserve currency. China's a mess. Europe is a partial mess. The world is unsecure in geoeconomic terms. So in relative terms, people are going to keep investing in the U.S. You were saying a little bit ago on the program about the increased interest in gold and Costco selling platinum to go with its meal kits. You know, this is Bitcoin. All these things are signs of people trying to seek alternatives to the dollar when there's no good state level, no good alternative currency. And I think all these investments will ultimately end in tears. But the fact is that temporarily gives the U.S. more room to run its fiscal policy, run its deficits. And that's part of why my forecast is that the deficits are only going to increase. It's not because I think that's good. It's not because I think it does no harm, but it is likely for the next few years.
Given all that you think about the direction